SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to the 9th SUERF and UniCredit Foundation Research Prize and Workshop. This year's call for papers and workshop is devoted to the topic of post-COVID non-performing loans, effectiveness and efficiency of government intervention, implications for banks. The COVID-19 crisis has, among many other things, caused a rise in non-performing loans. A combination of government measures has, however, helped to cushion the effects from COVID and containment measures on firm and household finance. In fact, the feared wave of firm and household bankruptcies did not materialize, which testifies to the effectiveness of these measures. As these measures are being phased out, firm failures and non-performing loans may, however, rise. Several questions arise. How severely will this affect bank balance sheets and profitability? What do bank stress tests tell us? Where are their limits? What are the implications for banks' business strategies, including loan provisioning, and for financial regulation and supervision? Finally, there is the burning question, what may lie ahead of us in terms of firm failures and non-performing loans, given the new shock that Europe's economies are currently facing as a result of the Russian invasion in Ukraine and the sharp sanctions by Western countries. Before we start with the program, let me express SUERF's appreciation of the long-standing, extremely fruitful and smooth cooperation with UniCredit Foundation and UniCredit's top management in this series of events on the occasion of the annual SUERF UniCredit Foundation Prizes. My special thanks here goes to Analisa Aleati and to Giannantonio de Roni from the UniCredit Foundation and to Pier Carlo Padoan, chairman of the UniCredit Group, for supporting our cooperation in such a dedicated manner. Over the years, we have, I think, very successfully managed together to provide opportunities for top financial sector representatives, for policymakers, and for academic researchers to exchange views and to develop our understanding of monetary and financial matters. This leads me directly to session 1 of our workshop, where Pier Carlo will give the opening keynote. Then José Manuel Campa, chairperson of the European Banking Authority, will follow with a keynote to give his assessment from the perspective of Europe's Banking Supervisory Authority. Without further ado, Pier Carlo, the floor is yours.
Thank you very much, Ernest, and good afternoon to everybody. Welcome to this event. I'm very proud to be here today to participate to this event and to assign the prizes to our young colleagues. My opening remarks will be very short and will start exactly from where Ernest finished, in taking note of a fact which is under our eyes, all of us, that we are discussing a situation relative to the post-COVID scenario. However, we are also dealing with a situation which is going to be unknown for some time. And indeed, and I will come back to this point later on, if there is one element which characterizes, at least to me, the current economic and social situation is big uncertainty. We simply do not know how this terrible humanitarian, military, and political crisis will end with, of course, all kinds of possible economic consequences. So we must make an assumption, like many times the economists do. Let's assume that there is no war in Ukraine and no invasion from Russia to Ukraine. And let's ask ourselves, how do we stand in terms of assessment of the post-COVID crisis? Well, Ernest already anticipated some of the points which I share. Well, one point is that when it broke out, the reaction of authorities and markets was quite swift and rapid. Markets and banking systems and banks and banking sectors put in place measures that were provided in order to avoid further negative consequences of the initial COVID shock, in terms of avoiding the so-called, first of all, avoiding the so-called cliff effect, in terms of resources, support resources suddenly being withdrawn after the beginning of the crisis. So a number of measures were put in place, including moratoria, provisions, and other measures dealing with abrupt interruption of activity. Also, the attitude vis-a-vis the assessment of NPLs, which, as Ernest reminded us, were expected to grow, were to be taken in ways that could be dealt preemptively. And therefore, putting in place one lesson, which I consider to be an important lesson from the previous crisis, the sovereign crisis, which left many banking systems and individual banks simply not prepared to deal with severe falls in activities and accumulation of NPLs without having at the same time appropriate instruments to deal with that. And that is one of the other lessons I draw from that experience. Fortunately, as I said, the recession proved to be less severe than expected. And so both the micro and the macro situation was better with respect to expectations. I mentioned the macro because at the outbreak of the COVID crisis, European authorities and governments also realized that the macro toolkit needed to be updated in order to deal with the very severe, initially very severe, but then rather short recession that COVID generated at the macro level. So we all know that there was a very important response at the macro level, namely by introducing the next generation EU system with very significant resources, but also, let's not forget this point, by lifting temporarily the Stability and Growth Pact restrictions on public finance and introducing a much smoother regime for state aid, something which is being discussed even today for the new sources of crisis. So in a nutshell, very simply stated, a combination of better than expected micro performance at the banking level and a stronger macro response, a fiscal policy macro response, with the addition, of course, of the important intervention by the European Central Bank, have generated an environment which up to a month ago or so promised to be a situation in which the economy in Europe could come back to a more normal situation very rapidly. Unfortunately, this did not materialize because of the new crisis in Ukraine. And however, and this is my final considerations on the situation, a few lessons can be drawn. One lesson is that we need, well, if you wish, we need to, when we deal with NPLs, we have to look at criteria for assessing their sustainability, but we also have to ask all the time, what are the instruments that at the national or the European level we have available to deal with accumulation of NPLs with problems that may arise. This is one lesson that, for instance, in the case of Italy was particularly relevant. When the banking crisis took its toll in the Italian economy, the Italian authorities found themselves with no weapons to deal with the NPLs accumulation effectively. Eventually, one instrument was adopted in collaboration with the European Commission. That is the GACS system, which proved to be very effective in spite of being limited in its scope. So this is just one example that leads me to say that lessons to be drawn have to be translated into practical new instruments and implementation in order to be effective. The other lesson, and then I finish here, is that, and excuse me if this sounds very naive, we are going to be entering a sequence of crises as we go forward. If we just look backward for a minute, up until 15 years ago, the situation was much less severe than it proved to be. Then we had the global financial crisis, followed by the sovereign crisis in Europe. Then, after a few years, which we thought were enough to we put back the European economy on a more stable situation, the COVID shock came in, totally unexpected. And then, of course, now we are coping with the Russian-Ukrainian crisis, which has severe economic consequences still to be assessed in terms of reaction to the policy environment, in terms of sanctions maybe, but also from the consideration of situations which have led many observers to claim that the stagflation environment is about to be seen. All in all, this brings me to finish with one obvious statement, which, however, I will never stop repeating, that institutions are needed to cope with crisis and hopefully to anticipate crisis or to build in the system sufficient resilience so that even if the crisis is unknown as to where and when it will happen, we know that we'll be ready. Every crisis has an upside, which is to learn from that lesson. Let's hope that this crisis also has its upsides. I'll stop here, and I thank you again for participating, and I hand over, I understand, to José Manuel.
Thank you, Pier Carlo, for your introductory remarks. I suggest we follow up with questions after José Manuel's keynote speech. José Manuel, over to you.
Thank you. Thank you very much, and good afternoon to you all. And thank you, Ernest, for the invitation and for organizing the event. It's for me a real pleasure to have the opportunity to share with you some of my thoughts on the post-COVID of the banking industry. I must say that I fully agree with, I think, everything that has been said by Pietro, Carlo, and also by you, Ernest. So I think that I might repeat some of the arguments, but I think it's important. It's obvious that as we speak, the post-COVID effects are now being overshadowed by the political and geopolitical developments emanating from the war in Ukraine. I think that uncertainty is the right word to use, but also hope that the war will end quickly. Today, let me focus on some of the aspects of the current risk picture of the banking sector. First, I'll start, like the purpose of the conference, with the impact that the COVID-19 pandemic had on the banking industry and how we used to view that going forward. And then I'll turn a little bit to the risks that we see arising from the ongoing war in the Ukraine. So let's start with the impact from the pandemic on the banks. I think that it's fair to say that it's already said that the EU banks have so far coped well with the challenges posed by the pandemic. One could say that in contrast to previous crises, the banks in this part were perceived to be part of the solution to the problem and not a source of the problem, a source of the crisis, which is a good position to be for the banking sector, I think. Now, I think it's important to say that the pandemic has not yet fully retreated. So I would say that it's not easy to conclude on the effects of the COVID-19 pandemic because, of course, essential measures are still in place. Fortunately, most of the health restrictions in Europe have been removed, but not in the rest of the world. And we're still subject to potential additional waves, particularly as we see the emergence of Omicron 2 variant and also certain parts of the world that are still experiencing significant lockdowns and economic restrictions to manage the effects of the pandemic. But let me take a step back to 2 years ago when the pandemic started and be brief. These last 2 years we experienced unprecedented situations that we needed to cope with or react against, both at the personal as well as the professional level. We all learned, and this is an example, new ways of working. We all managed to participate much more in a virtual environment that affected many, if not all, sectors of economic activity. So this has not been any different for the banking industry. During the pandemic, the banks faced several challenges that extended way beyond the initial operating hurdles that were confronted with like everybody else. But they faced particularly increased demand for liquidity, while at the same time they needed to evaluate promptly and accurately their customers' viability in a very uncertain environment at the time. And also with very limited visibility on what the macroeconomic expectations could look like in that environment, because they were very much contingent also on policy actions, as Pier Carlo very well highlighted. I must agree, fiscal and monetary support have been vital in absorbing the bulk of the macroeconomic shock, and I think we should extract lessons from that action and the role that assertive macroeconomic policies can have in absorbing such a shock, And at the same time, at the micro level, supervisory and regulatory flexibility also provided breathing space for banks and borrowers to address some of the problems that were being confronted. And that also some lessons that could be learned from from this crisis. Now, but I think that it's fair to say, at least in the banking sector, that some of the approaches, some of the way the banking sector was able to deal with the crisis would not have been possible without the regulatory framework that was put in place after the 2008 financial crisis, as well as the rebuilding of resilience that have been put in the banking sector over the last decades, reflecting again one of the final points that Pier Carlo just mentioned, about building resilience in the system. Well, I think that the decade previous to the COVID crisis helped to build that resilience in the banking sector in a way that has proven useful. In fact, banks we know entered the pandemic well capitalized and with sufficient liquidity to weather the storm early on. But since the beginning of the pandemic, capital and liquidity ratios have even improved further. At the beginning of the pandemic, a lot of our concerns was about making sure that there was flexibility in the systems. The buffers were there to be used. The banks will be able to use those buffers without any negative stigma effect. The fact is that most of those buffers, 2 years later, or 2 years onto the crisis, I should say, have not been needed, in the sense that banks have remained with significant capital ratios, in fact, increasing capital ratios and enhanced liquidity ratios. The average capital core equity tier 1 fully loaded capital ratios stood at 15.4 at the end of last year, which is around 40 basis points from the pre-pandemic levels. And the liquidity ratios have also increased since the beginning of 2020 by the end of 2021. In this context, also our EU-wide stress test that we ran last year with the results we published in July show also the banks will be able to withstand a severe economic scenario, which at the time, our stress scenario was characterized by the prolongation of the pandemic in a lower for longer interest rate environment. I think that the macro environment that we're confronted now, at least the specific the macro environment, is quite different. We're not obviously in a post-pandemic world. We're now in what we think is a post-pandemic world. It's not a prolongation of the pandemic, but we're looking at another source of uncertainty that's almost as large as we had it 2 years ago when the COVID started, and we're probably not in a lower for longer interest rate environment, more likely maybe on a period of normalization interest rate environment, but at the same time we're talking about a stagflation, which is a different environment. But nevertheless, the macro scenario that we put forward last year for the stress test implied and assumed 3.6% cumulative drop in European Union GDP between 2021 and 2023, and I think it's fair to say that so far so good. I mean that our current environment still is much more benign than what that severe stress test scenario forecasted in our analysis. Well, in that context, with that severe the stress test macro scenario, the banks fully loaded capital ratio would fall significantly by 485 basis points, but it will remain still very high, 10.2% on average in the system. And moreover, I would say that 90% of the banks in the stress test sample will remain well capitalized relative to minimum requirements. So I think that the situation of capital in the sector was quite abundant. If I were to mention liquidity, as I said before, the liquidity coverage ratio is close now to 175%, up from a little below 150% in December 2019. And I think that here again, the accommodative monetary policies have helped to back this trend on the liquidity ratios. Going forward, a possible tightening of monetary policies may drive banks' liquidity ratios back to pre-pandemic levels, but the starting position right now is again very comfortable. Now, I think that both the strength capital liquidity positions, jointly with the fiscal programs that have enabled banks to maintain lending flow to the real economy, have helped the economy support the shock. I think this was particularly important for the borrowers in most need. I think that since the pandemic, we have seen that loans in the European Union towards households have grown by around 4%, mainly lending on housing, an issue that I'll come back later on. At the same time, they have maintained roughly stable in terms of the exposure to non-financial corporates, but with a significant difference, with an market increase here in the lending to SMEs, which were probably the ones that were the most needed on liquidity in this process. Now, perhaps somewhat surprising, and this is one of the core topics for the discussion today, is that the bank's asset quality has improved during the pandemic, when of course our expectations was that there will be a significant deterioration, and we actually issue a number of public communications and warnings on that regard. In sharp contrast to previous crises, the pandemic has resulted in a decrease in corporate bankruptcies, as you know, tax breaks, furlough schemes, moratoria, public guarantee schemes, all the policy measures that were put in place, have probably helped to drive bankruptcy declarations in the EU to decrease by around 35% at the beginning of the pandemic in 2020. And although they have rebounded, they're still below their 5-year average. So it's a proof that support measures have been helpful, but it's also probably true that as support measures are withdrawn, bankruptcy rates will normalize further, and asset quality in banks' balance sheets will also be likely to be adversely affected. On average, up until now, banks report a lower ratio of non-performing loans to total loans than before the pandemic. The NPL ratio has maintained a decreasing trend throughout these last 2 years. Part of this overall decline, I think it's important to highlight, is due to the continued ability of some banks in countries where the stock of NPLs from the previous crisis was high to continue to dispose of those assets throughout the COVID pandemic. And here I want to highlight also another point that Pier Carlo also indicated before, which is the existence of these tools on how to enhance the NPL management, that we have developed over the last decade that have proven useful, and that we need to learn lessons from there. We are not now engaging ourselves in a peer review of how the application of our NPL guidelines has worked across the supervisory sector. And I think the news there has been quite constructive. We have been able to develop certain tools, certain capabilities that should prove as useful also as we go forward, if we need to, again, take an active management of NPL situations in different countries as asset quality deterioration may increase. Now, nevertheless, as I said before, the NPL ratio has decreased, but there's signs of increased deterioration of asset quality that cannot be overlooked in the system. I'm talking now prior to the events of the last month leading with the Ukraine. First, I think that there is an increasing rising volume of NPLs observed already on the sectors most affected by the pandemic, such as in hospitality-related industries, some of the tourism and travel industries. Moreover, there's an increase in forborne loans, which indicates that a growing share of lenders needs concessions before they are experiencing or are likely to experience difficulties in meeting their financial commitments. The cost of risk is low, it's true, but the overall share of loans classified under IFRS 9 Stage 2 remains more than 2 percentage points higher than they were at the beginning of the COVID crisis, i.e. at the beginning of 2020. Now, these trends, they seem to have stabilized in the last quarters, but their evolution needs to be closely monitored going forward. I think there's signs of credit quality deterioration that are more prevalent for those loans that have benefited from support measures, such as loan moratoria or public guarantee schemes. For instance, the total volume of loans, as you know, that benefit for some sort of eligible moratorias reached a peak of over 900 billion. That volume of loans is now much lower, it's residual, it's around 20 billion. The banks report that they have around 700 billion loans of expired moratoria, okay? Loans that were subject to moratoria, no longer subject to them. Now, when we look at those loans, at those portfolios, the asset quality is markedly lower compared to the total loans of banks. For example, around 25% of those loans that were at some point subject to moratoria, although that moratoria has expired, is currently classified in Stage 2 loans, and more than 5% of them are non-performing loans. A similar pattern also happens with the loans that have some form of public guarantee schemes supporting them. The banks currently report that they have about a little bit more than 370 billion euros in the balance sheet of loans that have or are benefiting for some kind of public guarantee schemes. But we observe again on those loans a similar characteristic of deterioration of asset quality. Around 20% of them, of these loans with public guarantee schemes, are now classified by banks under Stage 2, and the NPL ratio is above the total average and with an increasing trend over time. Now, to a certain extent, we might say that this was expected, as support measures were rather used by borrowers impacted the most by the pandemic, and obviously the policy measures were targeted to those sectors. It's also a sign that supervisory and other measures have really addressed the key issues in the economy, It's also a good sign that the banks are assessing them properly and they're making, if I may say, on time and timely assessments of the evolution of the credit quality on an individual basis and on a one-by-one basis. I think that's important, and I think that, but it's also true that I think we need to monitor them as we go forward in an effective manner. Now, perhaps a side effect of the support measures and some of the monetary policy measures that have been introduced over the last 2 years in Europe are the possible vulnerabilities maybe arising also in parts of the bank's loans portfolios. I'm particularly thinking, as I mentioned before, on the mortgage portfolios. Since the beginning of the pandemic, the banks have expanded their exposure in this portfolio. The outstanding loans has increased by 4% relative to 2 years ago. The low level of interest rates combined with pent-up household savings and abundant liquidity, I think, have resulted also in notably higher house prices in many EU countries. And I think that there is an increasing shared concern, about potential overheating housing markets, at least in some countries in the Union, and excessive lending and maybe relaxed lending conditions to some of those mortgage markets. Now, as we move forward, high interest rates could cause a slowdown in the market. But it's hard to predict what the actual impact on borrowers' ability to repay these mortgages may be, and this is an area of concern. Now, if I may, I also would like to point, before I talk about the Ukraine, about the structural issue that the banking sector had been confronted prior to the crisis, and that has remained through the process of COVID, which is mainly linked to, or can be mainly summarized on a challenge of profitability for the sector overall. We've been warning for a long time about the structural issues affecting the banking sector that have materialized in low profitability for the sector. The profitability challenge has been with us for a while. In 2020, the return on equity for the banks was below 2%. This return on equity has slightly improved over the last year in 2021 as revenues by banks were increased, but mainly through fees and commissions, and also some of the cost adjustments have been improved, but part of that has also been by releasing provisions. So as a result, the return on equity of banks has improved to more than 7% by the second half of 2021. But nevertheless, the levels of profitability might be hard to sustain in the long term, because of course, that some of these measures were temporary under COVID-19 and might have helped the banks. I already spoke about the likelihood that there may be some NPL increases as the exceptional macro monetary fiscal measures are being removed, but also the sustainable enhancements in revenue sources and sustainable enhancements in the cost base of banks, I think, are needed for them to enhance the profitability going forward. I think that on the revenue side, we know that there is expectations maybe that the increase in interest rates might help net interest income over the short term. On the cost side, I think we need to recognize also that the banks have to confront with investments in digitalization and complex restructuring process to adjust their operations, but more work needs to be done in that part to enhance the profitability of the sector. Now, if I may, let me just dedicate a few minutes before I finish on the situation with the Ukraine and how we see the risk outlook going forward. Although if I were to summarize it very quickly, I think Pier Carlo would just 2 words: increased uncertainty. I think that banks with the current situation have many reasons to remain vigilant. I think the macroeconomic outlook has become much more uncertain, but probably it's fair to say that the medium and long-term risks for the banking sector have increased rather than decreased. Our initial assessment shows that the first round effects are broadly manageable for EU banks. Direct exposures are relatively limited. I think that a few banks may have exposures to bigger exposures to some of these countries, but in any case, I think they could be easily absorbable within the existing current situation. In fact, we have already observed some first round effects, in the banking sector with the solution of some smaller institutions, but I think overall that is manageable. I think in addition, the sanctions imposed to Russian entities may pose operational challenges for some of the banks and also make some liquidity issues in some parts of the system. So far, that seems to be limited in terms of its negative effects. However, depending on the course of the war, we are going to expect many second-round macroeconomic effects and of very different dimensions. This will apply from lower consumer confidence and business confidence, disruptions in supply chains that we're already seeing, obviously inflation pressures by increases in commodity, energy prices. So these are likely to translate into a scenario which probably will have a lower impact on economic growth, and as a result of that, an indirect impact on the bank's profitability and also on the bank's outlook going forward. So I think it's important that we remain vigilant in that point. I don't think at this stage that we have any particular reasons to be concerned or specific concerns affecting particularly the banking sector or the financial system overall, but I think the uncertainty over the overall outlook is sufficiently large that prudence is at least of the upfront. From our point of view, we think in the short term there are increased in elevated operational risks. Some of them could be reputational legal risks because of the application of an unprecedented range of sanctions that have been imposed. We're also concerned about potential cyber risks that may be rising related to the possibly cyber attacks that may be enhanced as a result of the current tense geopolitical situations. So to summarize, looking ahead, so far so good, if I may. We are in a lucky situation of having come out of a very difficult COVID outlook with a much better outcome that I thought we would have predicted 2 years ago. But at the same time, I think at the same time, caution remains very much the crucial word and the crucial reference that we should all be thinking about, because the macroeconomic outlook remains probably more uncertain than ever. Let me stop here and thank you very much for the invitation, Ernest.
Thank you very much, José Manuel. This was a very, very rich presentation, a lot of food for thought. Maybe I give, first of all, before we go into questions, Pier Carlo the opportunity to react to your points. Pier Carlo, do you have anything to answer?
Well, first of all, I'd like to thank José Manuel for his, as you said, very rich presentation, and also thanks for picking up some of my points. I can only say that I very much agree with José Manuel. I reiterate the point that we have learned to different degrees on how to deal with, quote, more traditional financial crisis and banking crisis with respect to the crisis we've gone through, especially in some countries. The main lesson is always the same out of crisis, in my view. If there is a crisis, then there is something that needs to be fixed for the future. Unfortunately, sometimes we fix something that was going wrong in the past, but we are not able to detect what's happening in the future. However, there is one element of optimism, which it's about the general message that Europe has sent after the COVID crisis. And the general message is we need to overhaul and strengthen the fundamental economic institutions of Europe in order to deal with crises like the COVID one, which may hit in a generalized ways across the board, all member countries, and not only in Europe. Now, what is the equivalent response in the case of the current Russian-Ukrainian crisis? And the equivalent response to me has to do with economics, finance, but also security at large. We need to understand that crises become increasingly the result of several dimensions of instability, which have an economic dimension, a financial dimension, but also, as I said, a defense and security dimension, which calls as an answer, as a reply on the policy ground, for the production of more European public goods. Certainly, security is a public good which we are short of in Europe and elsewhere. Security in a broader sense, including energy security, by the way, as we know these days. So we need to make efforts to establish the production of public goods by strengthening European institutions. What we have learned from previous crises may help in two dimensions. One is that we may need more of the European instruments in the financial arena, and I'm thinking, of course, of the way Next Generation EU has been financed in parts with European bonds, not Euro bonds, European bonds. And the other one is that we need to understand very clearly that much of the specific elements of fragility that may appear, hopefully not, in the banking balance sheets are also very sensitive to the macroeconomic conditions. One point that perhaps I did not mention, but I had in mind of mentioning is that if we look at NPL performance over time, we see that there is often a strong correlation with the economic cycle. So keeping up a sustained rate of growth helps avoiding fragility in the financial system. Having said that, we will have to learn on a continuous basis on how to deal with the situation. Thank you very much again.
Thank you. José Manuel, do you have any immediate points that you want to respond with?
No, I fully share very much Pier Carlo's views, particularly on the building of resilience and public goods at the European level. I think that's a very important message.
Okay, then let me draw on some of the questions that have meanwhile been put into the chat. I would like to combine, first of all, a point by David Llewellyn with some of my own thoughts. David mentions that any form of war within Europe seems not to have been included in stress tests so far. This would probably have been regarded as a classic low probability, high impact risk. And I want to combine this with the idea put in the last point in the chat that our models, in banks, among policymakers, supervisors, regulators, central banks, our models are geared to deal with risk. That is something which can be calculated somehow. But both of you have pointed out the notion of uncertainty, which is characteristic of both the pandemic, but now even more so of the war situation and the sanctions. That is non-quantifiable, events. How can we deal with these in banks and among supervisors in a satisfactory way?
Well, I don't know whether Jose wants to come in. Let me just provide one simple to say answer, difficult to implement. The standard answer would be, rather than trying to quantify and therefore generate forecasts of crucial variables, one has to go with scenarios in mind. Scenarios are mostly qualitative exercises, which to me are useful for one purpose: try to establish a new starting point. So I'm trying to be very optimistic here. I assume that in a relatively short period of time, the security and economic situation in Europe, including Eastern Europe at large, will be stabilized because the conflicts on the ground will be stopped one way or the other. And therefore, we will have to start from a new, more severely damaged situation, but also with new perspectives, which could hopefully also answer the question, can we in the future consider Russia as an investing country, or should we not? I don't want to sound too brutal, but this is one key question. Should we consider this very large country to our east as part of the economic and diplomatic and political landscape that we will have to deal with in the future, or should we just erase it from the blackboard?
Yeah, if I may just, I fully much share the comment that was just made by Pier Carlo, but when thinking more specifically about the banks, and when we think about, like, for instance, our stress test that we run every 2 years, we constantly are asking ourselves, what's the macro scenario? What's the driving macro scenario that will then, what's the narrative of that scenario as well that will drive the possible 3-year stress situation? And we spend a lot of time building that. But at the end, it's also true that we know that that macro scenario then gets formalized in a certain numbers, in certain projections, and numbers that are the ones that are more sensitive for the outcome of the evolution of the bank's balance sheets. And this is obviously a much more narrow attempt, which is to assess the robustness of the banking sector. And that basically brings down to like 4 or 5 parameters, which is GDP growth, unemployment, increases in changes in unemployment, changes in the underlying interest rates, including risk premia, if built into there, and some additional change in the evolution overall of key prices, housing prices and financial markets. Those 5 range of parameters tend to be the key drivers of the shocks that the banks will be confronted with. Of course, as the question was said before, I mean, uncertainty is hard to quantify. I tend to think of risks as basically sort of the way that we internalize as human beings uncertainty, and we quantify it. It's like we see how much risk there is or opportunity, but in the negative part is risk. So again, from the bank's perspective, our approach, and that's why I made the reference to the stress test, is that the banks are ready to support a significant negative shock to the macroeconomic outlook, and that's a sign of confidence on their robustness at this stage.
Thank you very much. I want to use the last 4 minutes or so that we have for this session to now go deeper a bit on points that you have already alluded to. The one aspect is, what would stagflation imply for banks? I mean, both of you have mentioned this possible scenario. Is such a scenario envisaged for future stress tests? And the second question is a big question that Pier Carlo just has a little bit alluded to. Will the Russia crisis and the sanctions put a lasting blow to cross-border banking, particularly into emerging market economies more broadly, and put a lasting break on financial globalization? Maybe just brief philosophical answers to these big questions.
Okay, I'll go again first. On stagflation, stagflation is a very difficult animal to deal with. I remember the stagflation in the 1970s. And of course, by definition, there you have to separate the structural problems in the energy market from the macroeconomic monetary problems. And keeping in mind that in situations like these inevitably have a short-term dimension to avoiding the impact of high energy prices hitting too deeply into the economic texture, and the longer-term structural problems, so how to readjust the energy supply industry, so to speak, at large, which we need to do anyways because of the environmental targets we have in mind. So this is, to state the obvious, a complicated issue. I am concerned of the fact that we are now going to put a lot of money, including public money, in short-term measures, while at the same time we are not going to take these clear steps in terms of investing in alternative sources of energy, so that in a few years' time we are risking of being exactly where we stand today, perhaps even worse. So this is the concern. Stagflation can be dealt with, but it needs a very clear political indication of the long-term scenarios. On the banking, on the future of the banking sector, let me add just one note. Yes, we would like to see more integration in financial markets. However, let me remind ourselves that we know that we still have to do our homework as far as banking union is concerned. We are lagging behind what we badly need, which is a large and resilient financial union, meaning that we need to have a capital markets union and a banking union, possibly parts of one system. And we are very much behind, especially in capital markets union.
Thank you.
If I may, I'm very happy Pier Carlo brought this point, because I think it's crucial. I think that, as I said before, our direct exposures in the financial sector and banking sector to Russia and the Ukraine were very limited. But we are lagging behind, and this may be an opportunity again to enhance our own internal market, our banking union, our capital markets union, if I may as well, and in general financial integration. I think this is really where the crucial focus at this stage, I think, in Europe should be. It's like, how can we build a more enhanced, robust financial market that allows for better financing to the economy, better private risk sharing, and less reliance on public risk sharing. I think that's crucial opportunity. It's a step that's been pending, and maybe now we can make a step forward in that direction. That would be really good.
This brings us to the end of session 1. Thank you very much, Pier Carlo and José Manuel, for sharing your important insights with us. We now proceed to session 2, the 9th SUERF UniCredit Foundation paper presentations and award. Giannantonio and Analisa, may I invite you to introduce the session and the authors?
Thank you. And can you hear me? Yes. First of all, let me thank you, Ernest, for the exceptional organization of this workshop. This year, due to the COVID, held online again. And together with you, Ernest, let me thank also Dragana and the SUERF staff members. I'm here as a Secretary General of UniCredit Foundation, and I'm here to reward the winners of the 9th SUERF Unicredit Foundation Research Prize. This competition testifies, confirms the consolidated and fruitful, I'm using your word, Ernest, cooperation between UniCredit Foundation and SUERF. This prize, year after year, became more and more a tradition, and we all are proud for this because we work for reaching this important goal. I really hope to have the opportunity to welcome you all also next year. And let me hope, and I cross my fingers, in presence here at UniCredit in Milan. Ernest, you know that SUERF and all the SUERF members are always more than welcome here in Milan. But stick to the prize. Two are the winning papers of this 9 SUERF Unicredit Foundation Prize. The first paper is Public Guarantees for Small Businesses in Italy during COVID-19. And this paper is co-authored by Fabrizio Core from Tinbergen Institute of Erasmus University and Filippo De Marco from Bocconi University. Just a few words for both of them. Fabrizio is Assistant Professor of Finance in the Business Economics Department at ESC of Rotterdam. He is also an associate member of Erasmus Research Institute of Management and Fellow of Tinbergen Institute. His research interests lie in the fields of entrepreneurship, empirical corporate finance, and banking. Filippo is Assistant Professor of Finance at Bocconi University. He is a research affiliate of CPR, Financial Economics, and let me say, I'm proud for this because he is also an alumnus of our foundation. His research interests lie in the fields of financial intermediation and corporate finance. The second winning paper is Banking Diversity, Financial Complexity and Resilience to Financial Shocks, Evidence from Italian Provinces. And the author is Beniamino Pisicoli from the University Tor Vergata of Rome, Department of Economic and Finance. Beniamino is a PhD candidate in economics and finance at the University of Rome Tor Vergata. His research interests lie in the fields of banking, international trade and economics, public economics. Now, it's time to give the floor to the winners who will present their interesting papers. Thank you all. Congratulations again, and all the best to everybody.
Thank you very much, everyone, for having me here, presenting our paper, Public Guarantees for Small Businesses in Italy during COVID-19, which is joint work with Filippo De Marco. So let me start by motivating our paper. So the COVID-19 pandemic, as we all know too well, forced a global business shutdown with shelter-in-place orders. This, in turn, caused a severe liquidity crunch, especially among SMEs who do not have access to capital markets. Therefore, in response to this, policymakers relied on the banking sector to deliver government-backed liquidity in the form of public credit guarantees on private bank loans. Because of the aforementioned mobility restrictions, which limited access to the bank branches, applications and deliveries of these guaranteed loans were mostly done online. In this paper, therefore, we study the importance of banks' IT capability and of local banking relationship for the characteristics of these loans, their allocation, pricing, and processing time. Why we do that? Because if the banking system is heterogeneous in its abilities to process and deliver such fund, or if pre-existing relationship between banks and firms are sticky, there may be frictions which do not allow funds to reach the neediest firms. Let me give you an overview of the program that was put in place by the Italian government. So public guarantees in Italy are not new. They're fairly popular even in normal times, but they are partial, up to 80% of the loan, costly, so the firm has to pay a spread on top of the loan rate, and the application for a guaranteed loan need to be evaluated both by the bank and by the guarantee fund using a scoring system. On April the 8th, 2020, with the Decreto Legge Liquidità, the government created two new categories of guaranteed loans. A 90% guarantee for 6 years loans up to 5 million euros, and a full guarantee for small loans up to 25,000 euros, later increased to 30,000, for which there are no fees or credit check, and an interest rate ceiling formula that capped the interest rate to around 2% per time varying. Let me describe the process to obtain such government-backed liquidity. So the SME has to put forward an application for a guaranteed loan with a bank, which then evaluates the application and decides whether to give the loan or not, and then forward the guarantee application to the guarantee fund, which basically approves it. To run our analysis, we gather data from the guarantee fund, the Fondo di Garanzia, from which we obtain confidential loan level data with information on interest rates and processing times. We also have the information about the unique firm and bank tax codes, which we then use to match these data to balance sheet data of firms and banks that come from Bureau van Dijk Orbis. To give you an overview of the program, throughout 2020, Italian banks issued almost 1 million of these government-backed loans to around 900,000 small businesses for an aggregate volume of almost 80 billion euros. And here you can see the yearly evolution of the volume of guaranteed loans and guarantees. And as you can see, from 2019 to 2020, the outstanding volume of such loans quadrupled in effectively less than a year. So this program has been very popular among Italian firms. We divide our paper into three parts. In the first part, we analyze the extensive margin. Using a regression analysis, we isolate which firms' characteristics identify the likelihood of receiving one guaranteed loan. And we find that firms that are more likely to receive guaranteed loans are younger, more financially constrained, namely with less cash on hand, but the effect of firm risk on the likelihood of obtaining a loan is non-monotonic. So firms in the middle of the risk distribution, as measured by the Altman Z-score, are much more likely to obtain a guaranteed loan compared to firms in the tail of the risk distribution, so with very high or very low risk. Naturally, larger firms were more likely to obtain a 90% guaranteed loans because these loans are bigger, whereas smaller firms are more likely to obtain a fully guaranteed loan since these loans are smaller. In the second part, we analyze the role of banks in the allocation of credit. In particular, we focus on two main loan outcomes, which are the interest rate, which varies between 1% and 3% with significant variation across banks and firms, and the processing time of the loan, which we define as the number of days between the approval of the guarantee by the guarantee fund and the actual disbursement of the funds to the firm. What we find is that the variation in these loan conditions is mostly explained by bank heterogeneity, what we define as supply factors, rather than by firm characteristics, which we define as demand factors. Among the factors, the supply factors that matter the most, we find that better IT systems, proxied by the Google Play Store rating on the mobile banking apps, it's most important. Banks with better IT quality make 25% more guaranteed loans as a fraction of their total lending. They charge rates that are around 20% lower and process these loans twice as fast. Here, you can see graphically the association between the average interest rate of the loans given by the bank and the bank up rating on the x-axis. And you can see there is a clear inverse relationship between the two. Here instead, you can see the distribution of processing times for loans given by banks with low quality IT in blue. So banks that have an up rating of 1 to 3 stars. And in red, the distribution of processing times of loans given by high quality IT banks. So banks that have an up rating of 4 stars or more. And you can see that the red distribution is shifted to the left, meaning that high quality IT banks were much faster. In the last part of the analysis, we study the role of local banking markets. Because it is a natural question to be asked, if applications were filed online, is the bank branch network still relevant? Especially in a context in which the number of bank branches has been on a steadily declining trend both in Italy and around the world, and in which COVID accelerated the adoption of digital technology, as we all know too well, given that we are hosting this meeting online rather than doing it in person. Moreover, these government guaranteed loans are very cheap, they're made online, and they're available to everyone. So they provide the perfect setting to study whether the relationships between banks and firms are sticky in the sense of the Kreise and Dongina 2005. What we find is that albeit all this focus on IT, guaranteed lending remain local. So banks lend more in their core markets, namely in provinces where they have a larger share of their branch network, and in markets in which they have more market power, so provinces in which they have a larger share of local bank branches. Importantly, this last effect of competition matters for the mediating effect of banks' IT. So the sensitivity of loan rates to bank IT is smaller in more concentrated local banking markets. As my time is coming to an end, let me conclude. Our results indicate that bank heterogeneity, especially in terms of the quality of the IT infrastructure, is a crucial determinant of the quantity, speed, and pricing of guaranteed loans. But yet, the structure of the local banking markets and the bank branch network presence still matters for the overall volume of guaranteed credit. Therefore, policymakers should keep these factors in mind when designing policies that are meant to address liquidity shortages of firms, especially in times of crisis. And with this, my time is up and I conclude. So thank you very much for hosting me again, and I look forward to the Q&A and the other presentations. Thank you very much.
Thank you very much. I suggest we go directly to the second paper and collect questions then afterwards for both papers. Okay?
Thank you very much. I'm Beniamino Pisicoli, and I'm a PhD candidate last year, PhD student at the University of Rome Tor Vergata. And today I'm going to present my paper on banking diversity and financial complexity and resilience to financial shocks. So just a little bit of motivation. As we know, the COVID pandemic has imposed unprecedented challenges to the global economy. And even if this shock did not originate in the financial sector, the role of the latter is still crucial. and also because the COVID pandemic shock arrived after two other major financial crisis episodes hit the European economy. So this has given new momentum to the literature on the relationship between financial market characteristics and its stability. And we are trying to enter this debate by trying to answer to two specific questions. So, is institutional diversity in financial markets beneficial to stability? And does this matter, especially in bad times? But why should diversity matter? Well, first of all, more diverse financial systems seem to achieve a more diverse diversification of risk, in the sense that banks and financial intermediaries implement diversification strategies in order to minimize their individual probability of default. But if they are too similar, they will end up being very similar, implementing same strategies, same diversification strategies, and so this will increase the systemic risk. Diversity also breeds inclusion, in the sense that marginal consumers that can find themselves excluded from financial services when a single business model prevails are now better able to access financial intermediaries, and this promotes risk sharing, and so the financial system becomes more resilient. There could be also some beneficial effects of competition at work. Indeed, some recent theoretical literature is questioning the traditional charter value paradigm by Keeley, and some empirical evidence from Italy corroborates this competition stability nexus, even if the issue is still unclear and debated. So what are we going to do with this paper? First of all, we're going to measure banking diversity, so diversity in the banking system at provincial level by adapting the index by Mickey and Houghton. And then drawing from network theory, we're going to propose a measure of complexity of the financial system, of the overall financial system of Italian provinces. Let me stress here also what this paper is not about, because the wording can be a little bit confusing. We are not referring to complexity in terms of increased interconnectedness or geographic ramification or excessive sophistication attained by financial markets. We are using the word complexity only because we are going to implement the economic complexity algorithm by Hidalgo and Hausmann. And so the measure that we are going to compute should be interpreted more as an index of diversity and development of the overall financial system. So how do we measure diversity in banking? We're going to consider four dimensions in line with Mickey and Houghton, and this will be ownership diversity, is just 1 minus NFI-Lichman index calculated on bank branches by ownership structure, concentration and competition that considers bank branches by banking group. We're going to consider also the within province geographic dispersion of banking services, so an average distance from of bank branches from the capital city of the province, and finally also funding strategy diversity. So in the paper we use some aggregate indexes, and diversity OC stands for ownership plus competition, OCG ownership, competition, and geographic diversity, and finally we consider also the overall index that comprises all of the four dimensions, and it will take values between 0 and 5, with higher values denoting more diverse provinces. But of course the literature on financial crisis and financial stability has also remarked that alternatives to banks have been especially important during the great financial crisis, and especially during the sovereign debt crisis. So we want to compute a more comprehensive measure of diversity of the overall financial system, and we are going to apply the economic complexity algorithm by Hausmann and Hidalgo, whose traditional setting is export data, but we are going to use it and apply it to data on active firms in the NACEREV 2 section, financial and insurance activities. So the starting point is constructing a binary matrix whose element will take value 1 if the province has a revealed comparative advantage in intermediary X, and 0 otherwise. And summing over the columns and the rows of this binary matrix, we are able to get two key measures. One is diversity, and the other one is ubiquity. So the complexity algorithms differ in the way they combine these two measures. And Hidalgo and Hausmann use their method of reflection that basically means correcting provinces' diversity for the average ubiquity of its financial intermediaries, then for the average diversity of similar provinces, and this for 20 iterations until the algorithm converges. So we applied this algorithm to data on active firms by 5-digit sectors of the K section, financial and insurance activities. Our proxy for financial instability will be the non-performing loan rate. All this financial variable comes from the Bank of Italy statistical database, but we use also Bank Focus and AIDA balance sheet data for banks and some socioeconomic controls from Instat. So let me just here plot the evolution of the non-performing loan rate in the last decades. And some interesting facts here, as of course there are two peaks during the great financial crisis and during the debt crisis. And look at what happens in 2020. This is common knowledge by now, but when I was first writing this paper, this came a little bit as a surprise. And in fact, during 2020, Italian provinces experienced a decrease of the non-performing loan rate. And this it does not depend on the employed definition of the non-performing loan rate. So this is something that we have to take care in our econometric strategy. So we are going to estimate a linear model for answering to the first question. So is diversity beneficial to stability in general? We are going to also estimate an interactive model in order to understand if diversity is particularly beneficial during bad times, and finally also investigate some potential transmission channels by checking whether greater diversity leads to lower loan concentration as measured by different variables. So some results here, as we can see, all diversity measures are associated to a negative coefficient. So just to give a flavor of the economic interpretation, a 1 standard deviation increase in banking diversity leads to a decrease of more than 10% of standard deviation of the non-performing loan rate. And the same is true also when we consider the overall financial system diversity and development. Results from our interactive model shows that diversity in the banking system has been beneficial during all the past 3 crisis episodes that hit the Italian economy, while the situation is a little bit different for the complexity of the financial system that seemed to have been beneficial only during the debt crisis. And here, as we know, as we have said before, we are not able to disentangle which transmission channel is more relevant, but the literature has pointed to different reasons why diversity can be beneficial, can improve stability, and their ultimate effect is always the same: better diversification, lower concentration of risk. So here we are going to regress loan concentration as measured by the loan detained by the top 0.5% of borrowers on our financial diversity measures. And we find that actually the diversity, all the banking diversity measures are strongly negatively related to such variable. The same is not true for financial diversity. The situation instead is reversed when we consider loan diversity as measured by economic destination of loans, and the same happens also when we consider loan diversity in terms of borrower category. So to sum up, it seems that banking diversity and financial complexity increase stability in general and have been quite effective during the period of financial unrest. The benefits in terms of diversification are evident for both the measures, but the role of the financial complexity is more evident when we are able to consider some variables that take into account financing of less traditional type of loans and categories of borrowers. And so in this case, the role of non-banks is more evident and remarkable. So a vast array of robustness checks, alternative dependent variable, so different definition of the non-performing loan rate, and also different data for 2020 in order to take into account the government measures and private sector measures that may have decreased the non-performing loan rate in 2020. We're going to use data coming from March and June, where such measures were less effective or just started to be effective. And we are also having some instrumental variable estimates in order to take care of the possible demand effects affecting our loan diversity and loan concentration linear regression estimates. So just let me conclude here. In this paper, we have seen that a greater institutional diversity in the financial system is beneficial in terms of stability, and in particular during period of financial turmoil, and that the previous literature suggested that a more diversity in banking and financial system should lead to higher degrees of risk diversification by financial firms, and we have also showed that this is actually the case. So the argument for greater diversity is today more compelling than ever, and we have shown that financial diversity can be one of the arrows in our quiver for the post-COVID pandemic recovery. Thank you very much for your attention.
Thank you all, and congratulations again.
Thank you.
Analisa, can I ask 2 questions maybe?
Yeah.
Is that possible on the 2 papers? Do we have, if it's possible? So I have one question for Fabrizio. On your chart where you show the correlation between interest rate and app rating, and my question would be, does higher IT cause lower costs and thus lower interest rates on loans? Or is there a common underlying factor which might explain both factors, so both lower interest rates and higher IT use, for instance, better management, better governance in the bank? And a question to Beniamino, also very interesting presentation, based on your conclusion slide. So are bigger banks, therefore, likely more robust because it is easier for them to satisfy the diversity criteria, because bigger makes it easier to be in all kinds of regions, branches, and so on? So maybe you could briefly go into these questions.
Absolutely. Thank you very much, Ernest, for your question. Yeah, so what I showed you in the interest of time is just the most, let's say, telling picture. Of course, in the paper, we ran regressions by controlling for an array of other banks' characteristics, because, for example, quality of IT is partially, it's not the main thing, but it's partially correlated with size, for example. And bigger banks may, have lower funding costs, so have, an easier time setting pricing loans cheaper. But even though we control for several of these factors, the bank IT quality still retain its very high significance, and we always control in our regressions for provinces and industries fixed effect, the combination of these factors, in a way that we are always comparing firms within the same province and industry combination. So these firms will have very similar demand for credit. So we're not picking up the fact that, very different IT quality banks give loans to very different firms, because that's the issue of selection and demand. So in general, it seems that IT quality is definitely a part of the picture above and beyond other banks and firms characteristics.
And as from my side, yes. So the paper was trying to state is that it is not, at financial system level, it is not one business model that is better than another one, but is rather the combination of and the coexistence of these different business models that make the financial system more resilient of course, the bigger banks probably are more efficient, but also the mutualistic business model has its own merits, and the coexistence of these different business models, different risk appetites, different diversification strategies, different clientele is what is beneficial in terms of stability. But of course, if we want to think about more micro, a more micro approach, well, we can say that bigger banks will achieve a greater geographical diversification, and this is thought to be beneficial for its stability, and it will also probably diversify their instruments. So, for instance, using also leasing and factoring instruments that in the last are growing in the last decades and have been very important for the recovery of firms from the great financial crisis and the sovereign debt crisis. So in a sense, we can also think of the paper in that way, but what I want to stress is that the results show that financial systems that are more resilient are those in which bigger banks coexist with smaller players that have a more local orientation. Thank you.
Thank you so much. Analisa, do you want to have a final word?
Just to thank you all.
Thank you very much. Dear Fabrizio, Filippo, and Beniamino, once again, warm congratulations for the 9th SUERF UniCredit Foundation Award. Really brilliant papers, and we all enjoyed reading them and hearing your short presentations. Thank you very much. We now proceed to the final session 3 on Corona and non-performing loans, empirical evidence and outlook. May I warmly welcome Elena Carletti, member of the Board of Directors of UniCredit Group, Professor of Finance at Bocconi University, SUERF Fellow, among her many other functions. Elena, please moderate the sessions. The floor is yours.
Thank you, Ernest. Thank you for the nice introduction, and thank you for having me here. I feel very much at home here between SUERF, UniCredit, and also in part Bocconi for one at least of the prize winners. So I'm very pleased to be here. And let me congratulate again the 3 winners, so Fabrizio, Filippo, who is my colleague, and Beniamino for the prize awards. So let's move now to the panel, and let me start by introducing the speakers. We have a quite rich panel. Let me introduce first in alphabetical order Thorsten Beck, who is the chair of financial stability at the European University Institute, but also my successor as director of the Florence School of Banking and Finance, and also he is also a SUERF fellow. Then we have Maciej Grodzicki, and I hope to pronounce it correctly, who is an advisor in the Systemic Risk and Financial Institution Division at the European Central Bank. Then we have Jakob de Haan, who is the SUERF president, but also University of Groningen, and Rainer Martin, lead economist of the joint Vienna Institute. So we have a lot of speakers, and you will hear they have lots of interesting points and interesting aspects to cover in the discussion of the NPLs. So we would like to distinguish to the extent possible the discussion in at least 2 parts. The first part without the Russian invasion, and then we may say a few words on the Russian invasion, in particular with Maciej, who will help us also in understanding better the ECB scenarios, the latest ECB scenario that have been presented due to the new situation. So we will have a first part on COVID and before, both what has happened, what we see, and what is the outlook from there. And then we possibly have a second round more on the recent events. So for that, we thought of the following order. We start with the Jakob, that will speak more on a piece of research that precedes COVID. Then we go with Maciej, who will instead talk a little bit more on the COVID situation. And then Rainer and Thorsten, that will focus, yes, on COVID or even before, but they will also be more oriented on the outlook, and in particular, Thorsten, on the exit from the public measure from COVID. So let's start with the Jakob.
Thank you very much. It's a pleasure to be here. And as you rightly pointed out, Elena, this is work that deals with non-performing loans. But in doing so, we use data before the COVID-19 pandemic. This presentation is based on a position paper that I wrote last year for the European Parliament. Apparently also the European Parliament has a clear interest in non-performing loans. And what I decided to do in this position paper was to dig deeper and see whether we can explain the non-performing loans performance of banks in Europe. Next slide, please. Let me start by saying that I was kind of surprised to find out that in the academic literature, there is only very limited evidence about the drivers of NPL. Those few studies that I managed to identify suggest that pre-crisis NPLs are definitely not a good indicator of future NPLs. So that means that macro and banking conditions should be considered, and that's precisely what we do in this paper. This paper, I'm not going to present you any details, but I'll just tell you what we did in the paper. In the paper, we estimate an empirical model for NPLs using a very large sample of banks in countries in the euro area, covering the period 1995-2019. As you can see, indeed, before the COVID-19 pandemic hit the euro area. To complement this analysis, the position paper also offers a case study of the situation in the Netherlands. Next slide, please. So, what are we doing? Well, previous studies, the scanned previous studies that exist, suggest that economic activity, but also interest rates matter when it comes to the drivers of NPLs. So we include those variables in our model, and we also include several bank-specific variables. Here, the literature is extremely divided. Several studies include bank-specific variables that we decided not to include because they may be endogenous, or the causality may go in the other direction. Furthermore, the evidence on the role of bank-specific factors is extremely diverse, in the sense that there is very mixed evidence for these bank-specific variables. So what we decided, therefore, to do was to select only a few bank-specific variables in our model that are obviously not suffering from the potential of reverse causality, and where also the literature comes up with sufficient evidence that they may matter. Next slide, please. So what we include in our model are loans, obviously because banks trying to increase their market share are likely to reduce its minimum credit standard, and which therefore increases the chances of defaults by borrowers. And we measure this by the loans to assets ratio. We also include bank capitalization because managers in banks with low capital bases face a moral hazard incentive to engage in high profitability but high risk lending. So we measure capitalization by the ratio of total equity to total assets. And then we include loans to deposits, which are measured as banks' deposits to total liabilities. Next slide, please. Oh, that goes too. Yeah, there it is. So where do we get our data from? We use data from Fitch. And Fitch provides a lot of information and data for banks. We included all banks located in the euro area at a consolidated level. As I said before, the period covered is 1995-2019. So all banks that are in the Fitch database and for which Fitch provides sufficient data have been included in our analysis. So as a consequence, we have a huge database of almost 19,000 observations. Next slide, please. So what do we find? I'm not going to show you tables with regression results, but I'll just summarize our main findings. These findings are pretty interesting, I think. First of all, we find that macroeconomic factors, notably GDP growth and the unemployment rate, are important and very robust drivers of the NPL ratio. So that suggests that the macroeconomic situation is a very important driver of NPLs. What we also find, and that has been suggested by several previous speakers before, is that after the global financial crisis, the NPLs have increased. The position has increased. So that means that there's a lower NPL ratio. Interest rates, interestingly, hardly matter. And so in one or two regressions, we find that there is a marginally significant effect of interest rates, but it's only significant at most at a 10%. Surprisingly, second conclusion, we find that several of the bank-specific variables that we considered are not significant. The one that is most significant is LTA, but to a lesser extent, also we find that equity matters. The better the capital position of a bank, the lower their NPL performance. Most interestingly, however, we find that all these variables that we included can only explain a very small part of the variation of NPLs of the banks in the euro area countries that we considered. So this suggests that other factors apparently play a key role in driving NPLs. Next slide, please. And that is why the position paper also offers a case study of NPLs of banks in the Netherlands. The reason that I focus on NPLs in the Netherlands is obvious because I am more familiar with banks in the Netherlands than in other countries. And we had access to reliable data for this. It also allowed us to include the COVID period. And this analysis of Dutch banks suggests that government guarantees, even though they are very important, as we heard from several speakers, they will only shield a very small portion of outstanding bank loans. Furthermore, tax deferrals, which is also in the Netherlands one of the policy measures that the government took to combat the economic consequences of the pandemic, may eventually affect NPLs. Here on the slide, I mentioned data for January 2021, and by then there were almost 13 billion tax deferrals outstanding. This morning, I got the most recent figure referring to the situation right now, and this amount has increased to 20 billion. Next slide, please. Goes too fast. Finally, in the position paper, in the case study for the Netherlands, we also report the outcomes of a survey among Dutch banks. And that is important because Dutch banks, like many other banks in other countries, have issued payment deferrals, or moratoria, as they also known. And these, of course, allow customers not to pay interest and or repayments on the loans for some time. And the survey among Dutch banks suggests that banks expect for 29% of the customers higher credit losses in the future. And this suggests that even if the economic recovery at the time of writing, as forecasted by the Commission, the NPLs will rise. So my conclusion is that even though the economy at the time of writing was doing well, so this is last year, and the forecast by the European Commission suggested that there would be a swift economic recovery, and that in itself, according to our estimates, would suggest that NPLs would decline further. However, once you take these specific factors into account, which are not included in our empirical model, then my conclusion is less optimistic, because these huge amounts of tax deferrals, as well as the amount of moratoria and the expected losses by banks on these loans suggest that after the COVID pandemic, it's likely that NPLs will increase further. And this is not even taking into account the current situation with respect to the war in Ukraine. So by that, I think I'm finished. So I thank you very much for your attention, and I hand back to Elena.
Thank you, Jakob. We will go back to this in the discussion afterwards. Let's now move to Maciej, who will talk more about COVID, the COVID situation now, and then we will go to Russia afterwards. Maciej, let's see if your screen comes.
So thank you very much for the opportunity to speak and present. I have to start with the usual disclaimer that the views presented here are mine. They may not always necessarily reflect the views of the institution I'm employed by, so the European Central Bank. And I'd like to cover actually 3 points today. So first, start with asset quality development during the pandemic, and that draws quite heavily on the work that has been published over the last 2 years in the ECB Financial Stability Review, as well as a new article, which I'm going to advertise in the Economic Bulletin, which was pre-released today and will feature in the full bulletin to be released tomorrow. The second area I'm going to cover is the role of NPL markets in NPL reductions. And finally, I will also highlight one area which we identified as being in need of further action, namely improved creditor coordination. So with that, I can jump to the first slide on substance and start with a brief outline of NPL developments. And I think many people already here said that when the pandemic broke out, we all probably expected that NPLs are going to increase sharply as firms lost a source of cash flows but had to service their debt and had to pay fixed costs. And I think if you look at what came out from the bank's risk and accounting models, this expectation was in a way confirmed by the models. So under IFRS 9, I'm sure you know that banks identify loans as representing higher credit risk, and this is called stage 2 loans. And the identification is done based on a mix of model-based signals and expert judgment. And you can see here that banks moved a sizable part of their corporate loan portfolio and total loan portfolio to stage 2 during the pandemic. So the net inflows, the red dots on the left panel, were significantly positive throughout 2020 and 21. But contrary to these initial expectations, and this is what you see on the left panel of the right-hand side chart, the NPL ratio basically continued to decline in an almost uninterrupted way, to the lowest level since at least the global financial crisis, just above 2% of total loans. And the cost of risk, despite some increase, normalized quickly. So that suggests that banks built precautionary provisions, but they did not have to use these provisions to meet incurred credit losses. And looking at this from a perspective of observed defaults, I think the picture is confirmed. On the left-hand side, you can see here the scenarios that were laid out by market analysts. This is one specific rating agency, but similar picture came from other market analysts. Default rates on corporate bonds have repeatedly beaten even the most optimistic scenarios that market analysts produced during the pandemic. And the same observation holds for bankruptcies, which again, it was remarked here. There is some sectoral differentiation, of course, but overall bankruptcy rates are consistently below pre-pandemic level and only picked up quite recently. So that stark contrast between the initial expectations, economic intuition, and the outcomes goes back further investigation. And policy support to firms via wage subsidies, grants, moratoria, guarantees is an obvious candidate to explain the gap. So next, I'll I'll show you some results of the analysis we've done looking into loan level and firm level data for more than 1 million firms in the euro area, which we could match to bank loans available to us. And how can stage migrations to stage 2 in particular be explained with these data? And our conclusion is that the risk models that are used to generate stage 2 transitions reflect deteriorating fundamentals. So first, and this is what you can see here, there's generally quite a strong correlation between turnover losses at the industry level. So we don't have that at the firm level, but we have that in the industry level with quite a lot of granularity. And frequency of migrations to stage 2. Essentially, sectors that were more affected were also seeing more migration to stage 2. So bank models did a good job in identifying vulnerable sectors, you can say that, but the relationship is noisy, which you can see here clearly, and that points towards other factors. One of these factors is pre-pandemic firm level vulnerabilities. So as I said, we don't know, we cannot track these vulnerabilities in real time because balance sheet data come with a long lag. But we verified here that, and we have also econometric proof if interested, that bank models for stage 2 do reflect these prior vulnerabilities. And sort of going through these 3 charts from left to right, you can see that more leveraged firms, less liquid firms, and less profitable firms were more often migrated to stage 2 and also to stage 3, which is more or less equivalent to non-performing loans. Now, the share of loans that move to stage 3 is much, much lower than those that move to stage 2. And that is an interesting question. So we looked into what firms received support. And I think that ties in quite neatly with some of the work that was presented in one of the awarded papers. So we're here seeing that firms which benefited from guarantees and moratoria were generally more vulnerable than your average firm. And this essentially shows that in addition to some work that we've done with balance sheet simulations, that this policy support has indeed played an important role in offsetting the shock to firms' cash flows, and that contributed to maintaining ability to pay. So moreover, you can see here that the more vulnerable the firms are, the more likely they were to make use of multiple support programs, not just one. The big important missing piece here is the use of wage subsidies, which we know was a broad-based measure used in many countries that also played an important role. So what I said so far helps understand perhaps why there were so few details. I'd move to my second point, which is why did NPLs continue to fall during the pandemic and not just stop, let's say, didn't rise? And I think I'd like to point out here that NPL markets have been very important in explaining total reduction in NPLs in the euro area. In 2014, we had more than 1 trillion of gross NPLs. We were down to about 500 billion when the pandemic started, and over 90% of that net reduction, so nearly 600 billion euros of gross NPL reduction, was due to sales and securitizations. And in the pandemic year alone, in 2020, over 60 billion of NPLs was transacted despite the market freeze for a couple of months in the pandemic. And I think the activity is partly due to the decisive response that was undertaken in 2017. There was, I'm sure many of you remember the Commission Action Plan, which helped unlock the potential of NPL market. It did contribute to more transparency around NPLs, more legal clarity around NPL markets and transactions, to supervisory guidance on how banks should manage their NPL portfolios, and also to phenomenal growth of a rich NPL servicing ecosystem. And there's another important point that government-sponsored schemes for securitization compliant with state aid were becoming increasingly important in Italy and Greece in particular, but overall at the euro area level, these two countries and their securitization schemes account for nearly 40% of all NPL trades. So there is, let's say, a role of the state support here as well. And my last point connects to our work in a recent special feature in our financial stability review. Essentially, it departs from a question that does the benign NPL outcome mean that there's no further issue to deal with, and essentially we can assume that we will all live happily ever after? I think the answer is probably no. So we identified here one clear area of interest. Many firms in Europe, and this is what you can see on the left panel, have multiple creditor relationships. And there is evidence that these firms with many creditors are more likely to have non-performing loans. So the more creditors your firm has, the more likely it is to to have a non-performing loan. And moreover, we have evidence that these loans are more complex and take more time to resolve. So that is in keeping with possibly misaligned incentives that multiple creditors could have vis-a-vis one another, and that complicates the resolution process. And that notwithstanding, and you can see that from the right-hand side panel, the more creditors a firm has, and if it is non-performing, the less provisions would banks collectively set aside for that exposure, which I think is an interesting finding, because that contradicts the issue that these loans may have higher recovery costs and longer recovery times. So what to do about it? Well, we're saying in our special feature that one can consider a coordination platform, a data platform, where investors could look at pooled loan data from multiple banks to identify these NPLs with multiple creditors, and then they could buy a qualified majority of the debt to essentially set aside the coordination problem and be able to restructure this almost as if they were a single creditor. We've done some illustrative analysis of the possible financial impact, and we're showing that the benefits of such a platform could be almost as sizable as the impact of government-sponsored securitization, which I think is quite important and would improve outcomes for both creditors and debtors. So with this, let me very quickly recap. I think our most important lesson from the pandemic is that first, past investment in NPL markets has proven useful to maintain good momentum, and also extensive policy support was very important in preventing new defaults. And then further work on addressing information asymmetry and creditor coordination could lead to better outcomes in future crises. And let me stop here, and I know we'll have further discussion on the outlook later on. Thank you.
Thank you very much. Let me just ask a clarification question before we move to Rainer. And the clarification question is, when you say that firms with the pre-existing vulnerabilities, for example, a higher leverage or a less liquid asset, they also are those that have picking up programs more, so other moratoria, guarantees, and so on. Are you somehow also considering the exposure to the COVID shock of these firms, or we do
that. We essentially put, so I was showing a lot of visual evidence, but behind that there's econometrics, which puts all of this in a multivariate setting. So I think you can safely say that this.
No, but what I mean is, so for a given exposure to the shock, then you see that weaker firms are those that pick up the programs more, or also irrespective of their exposure to the shock. I guess this is my question. So how the exposure to the shock enters.
Well, I think it would hold for both. So regardless of, it does change obviously the size of the impact, but I think the conclusion is that.
Okay.
I mean, because you've also got industries where firms are not
exactly, because this
affected.
was such a sector-specific shock, right? Yes. That's why I'm asking.
That's fair to say. Thank you.
Okay, let's now move to Rainer, who will bring us a little bit back also to pre-COVID, but then we'll start with a little bit more forward-looking outlook, and then we go to Thorsten.
So I will indeed go a little bit back a few, sorry, what is this? Okay, something went wrong on my computer, but you still see the slides, do you?
I see the slides are not that big. I mean, the screen is a little bit small, but we can see the.
Let me do that again, sorry.
We can easily, perfect.
Okay, it's better now?
Okay, let's go with this.
Okay, perfect. Thank you very much. So first of all, thanks a lot for the invitation to present here. It's a great topic and a great set of panelists. I'm very happy to be part of it. So I will indeed go a little bit further back into history, just a few years, and look at some of the lessons that we have learned from the previous wave of dealing with non-performing loans. And let me start just by recalling how pretty bad the situation was just a few years before COVID. So in the period between around 2010 to 2015, 16, we had a really a major NPL issue throughout the euro area, in most euro area countries. In some countries like Greece and Cyprus, we were talking about NPL ratios in the 30s and 40s. So indeed, this was a very serious issue, and a lot of analysis and policy making went into trying to deal with that, and I think quite successfully. So one of the things that I think were learned quite effectively, maybe the hard way, but nevertheless they were learned this way during these years, was that when you deal with a protracted NPL problem, there is no silver bullet. There is not a simple solution that gives you what you need to do, and then somehow this problem will disappear. So there is indeed a wide range of impediments that come into play here, and I think one can distinguish them between supply side problems, demand side problems, and structural or legal issues. And when you talk about supply side problems for NPL, that may sound a little bit strange, but actually these supply side problems refer to the unwillingness by banks to, at some stage, to really identify non-performing loans and then really to take measures to deal with them, to manage and to resolve them. And there's sometimes it's an unwillingness, sometimes it's also an inability because of lack of capital, for example. But there are sometimes also quite simple but very important problems like bans or restrictions on the sale of loans to non-banks, for example, which is of course something that undermines the whole idea of a secondary market. On the demand side, there are a lot of information asymmetries between the quality of distressed loans, between the buyers and the sellers that need to be overcome. And there are many barriers to investor entry. And in Maciej's presentation, I think he was illustrating rather nicely how important this part is, because this demand side is ultimately what is needed to generate a secondary market for non-performing loans. And lastly, there are the structural and legal issues which play a big role in many countries. So there can be weak or unpredictable insolvency frameworks, difficult collateral enforcement situations, and sometimes there is also an insufficient loan servicing ecosystem. Now, many of these problems, as we said already before, have been solved in the meantime, and that is a very, very good thing. And the EU Council Action Plan on NPLs from 2017 played a very, very big role here, because it provided concrete policy steps to basically tackle most of these problems. Another important lesson that we learned during these years of high NPL ratio was that different problems require rather different solutions. Because when you have to deal with an high NPL situation, first of all, it depends what asset classes are primarily affected by this. And there is a lot of differentiation across countries, also across countries within the euro area. And which tool you're actually using, or which tool is the most suitable to deal with these problems, that is not always the same. So in this chart here, which is taken from an Asian Development Bank publication from last year, where the ECB and also Maciej and myself have contributed to, we're talking about the key asset classes that are typically used, and it shows that a number of sales, like of approaches like the direct sales, debt restructuring, securitization, can be used for many of these asset classes, but not all of them can. It also stresses the role of public AMCs, asset management companies, sometimes also referred to as bad banks, that played a role, an important role in some euro area countries. And I will get back to this in the second part of my presentation when we are more looking at the forward-looking developments and policy actions. So let me wrap up this first part. And I think the key conclusion that one can draw from this, and this is what allowed this rather benign and very positive development of NPLs during the COVID period, is that indeed this time was different. So first of all, and this was also mentioned already earlier, the banks in Europe were much better prepared to deal with possible loan losses than they were in the past. There was higher capitalization, which allowed them to resolve loans. There was higher loan loss provisioning levels, and so on. So here a lot of lessons were already learned. There was also, and this should not be underestimated, there was a much better understanding of NPL management and resolution approaches, both on the side of the banks, but also on the side of the regulators, because they also went through a rather steep learning curve when it comes to this issue. And then, of course, I don't want to go into any details here because you're all very familiar with this. There was a whatever it takes policy mix that was approached, that was used in this case. There was a very substantial anti-cyclical policy mix integrating also, and this was something new, macroprudential and regulatory policies in this mix. There was, of course, the ECB's monetary policy stance that was very, very accommodative. And this is quite important, there was an EU level easing when it comes to various rules. So in particular, fiscal rules, state aid rules, and competition rules. And I will get back to this part in the second part of my presentation. And last not least, of course, there was a much higher level of political willingness to support the banks. And this is, I think, in stark contrast to the situation that we've seen in the years before. So everybody knew the crisis didn't originate from the financial sector. It was not a problem. It was not a culprit. It was seen as part of the solution. And I think that led to a rather dramatically different approach compared to what we have seen before. So I will stop here and then get back in the second round with the second part of the presentation. Thank you.
Okay, thank you very much, Rainer. Let me ask maybe a question before we move to Thorsten, which refers to what you said. Of course, with COVID, banks were much more prepared because they were already coming out of a wave of NPLs. But to some extent, some people may say, yes, although the type of NPL during COVID may have been different from those before, because before it was more mortgages related, if we want to say, whereas during COVID it was, and if we will see more going forward, it will be more relating to loans and to corporates. So in your view, to which extent these banks were really prepared? I mean, we could say that the way we can dismiss, or sell, or securitize NPL coming from mortgages is not the same as coming from corporate loans, and in particular, the recovery that you may expect may be different, the level of collateralization and everything. So what is your view on this?
No, I think that's a good point. I think in some countries, actually, already before COVID, there was quite a large share of corporate loans in the distressed asset market. I mean, as you know very, very well, of course, for Italy, corporate loans were always a substantial part of the NPL stock, and the same holds for a few other countries. Now, for those countries where the problems mainly arose from a real estate boom and bust cycle, like Spain, of course, the situation was indeed quite different, absolutely. And it's indeed not the same to resolve mortgages or to resolve corporate loans, but some of the basics is rather similar. And I think also some of the, say, legal and regulatory infrastructure within which the banks operate is beneficial for all assets. So I would say the level of preparedness was not the same throughout the countries, but it was certainly in all cases higher than what we had seen before, the previous one.
Yeah, no, that's for sure. Okay, let's move then to Thorsten, who will bring us more in already a little bit more in the exit from public measure that all of you actually have highlighted and underlined the importance of having public support when dealing with the NPL. So let's see what Thorsten thinks about potential exit from these public measures.
Okay, thank you very much.
Exactly.
So I'm not sure I should go through all the slides. Let me just first say this is actually to a large extent based on a paper that we also wrote for the Econ committee together with Brunella and with Elena. I mean, so again, this has been mentioned. This time was different, both in the form of the crisis, but as Rainer just said, also maybe also in the outcome. I think the banking system has been really part of the solution. I mean, others have mentioned this before, including José Manuel, but of course also with a big helping hand from the government along all dimensions. I mean, capital relief, the kind of suspension of certain loan loss provision and classification rules, and of course then all of these the moratoria, especially also the credit guarantees. Now there was actually, and this comes out of a ESRB report we did last year, or we actually did towards the end of 2020. There has been a wide variation to which extent such moratoria have been granted across countries of the European Union, but then also being when it comes to guarantees, a similar variation, but then also in terms of the use actually, for how much is actually has been the amount has been actually used. What I want to talk more about now actually is more how to exit from the crisis. Now, some of these remarks, we wrote this last fall, so half a year ago. I mean, sometimes it seems like a couple of decades ago, given recent events. But I think some of this actually, we could also bring in a little bit what's happening right now, the invasion of Ukraine by Russia and the economic problems that will cause in some countries within the European Union and, well, several, I guess, but again, with quite some variation. Now, as mentioned, I think it was Maciej who mentioned that there's not just variation in terms of across countries, in terms of the guarantees, but also in terms of which firms actually got these guarantees. And that actually would even reinforce the point I'm trying to make here. Well, some of these firms will definitely be over-leveraged. And the question is, I mean, again, so far, everything looks fine. The NPL ratio hasn't gone up that much. It has gone up somewhat, but not that much. But the question is some of this being held back still, or are there still skeletons in the closet that will come out eventually? And then the question is how to deal with them. And we've just seen Rainer talk about, I mean, how to deal with widespread waves of NPLs. And again, I mean, so far it looks all fine. The question is, will we actually have to go to some of these kind of more systemic measures to address NPL waves? And again, also maybe in the context of the Ukraine invasion and the repercussions, and maybe there's even also still worse to come, given that we're only like a month into this war. And of course, once we talk about the corporate side, this of course feeds back into the banking side, and of course ultimately into the government side, into the sovereign debt side. This is a little bit beyond what we're talking about here, but of course there's this whole question about monetary policy, how will it react? I mean, the ECB has been, I mean, some would argue, has been behind the curve compared to both the Bank of England and the Federal Reserve. It has kind of caught up, I think, in the last meeting in terms of at least at the QE and the tapering. But of course, the question is, will it have to go even stronger? Should it go stronger? What are the inflation expectations? I mean, I've seen work by Ricardo Reich that inflation expectations are really kind of still anchored very much in the euro area compared to the US. But the question is, will it stay so with the high increase in the energy prices? And of course, I mean, I've been mentioning this already. I mean, the Ukraine shock is really on top of this COVID shock. It might delay things further. It might make things worse in certain in certain sectors. And maybe just to bring this in as well, I mean, I think José Manuel has alluded to this already. I mean, the banking sector in the medium run faces several issues, including transition risks in terms of climate change, transition to net zero. Some of these risks might materialize a little bit quicker now. with a forced accelerated energy transition. So there might be more stranded assets, or there might be more non-performing assets coming up, which ultimately might exacerbate some of these problems that have been accumulated already. In the paper, we kind of do a bit of a comparison, which is, again, goes a little bit beyond what we're discussing here, because it's more a macroeconomic issue. I mean, how do we think about withdrawing these support measures? And I guess there are two ways to think about it. And actually, we have a similar discussion again now. So Keynes versus, we call it Keynes versus Schumpeter or Hayek. Keynes in kind of maintaining support as long as possible to avoid hysteresis, to avoid that people lose their jobs. And of course, the current discussions on subsidies or tax cuts for petrol kind of go a bit in this direction, although I think in this case they are probably wrong. The other is clearly the Schumpeter-Hayek view is really let markets rule. Let's go off these support measures as quickly as possible to allow for the necessary reallocation. And again, something similar, you can think about the energy transition right now. I mean, pushing this forward even more quickly might actually be, we could argue, at least in the medium to long term, a win-win situation, both for climate change as well as for geopolitical reasons. But of course, there might be short-term pain, which politically speaking, I personally think we should be able to, bear. But of course, it has implications possibly also for the banking sector. Right, let me then just maybe come to this one slide, which was actually kind of the initial kind of focus of our of the paper that we, Brunella, Elena and I wrote, is to kind of how do we think about exiting from support measures. And again, this was written half a year ago. Some of this might not be as relevant anymore. But the point we wanted to make is that we really have to see that lots of authorities have put into place support packages at the beginning of the crisis, during the crisis in 2020. Kind of this was not really that coordinated, or it was coordinated maybe in the background, but not kind of obviously. But I think the exit really has to be coordinated. I mean, for example, returning to standard loan classification, we have to think about what to do with the moratoria, the payment moratoria. You want to exit from guarantees? Well, you could see a rise in corporate insolvency. Are the courts, are the insolvency frameworks ready to handle such insolvencies? You return to standard regulatory requirements, maybe going back to the Basel III timeline schedule. Well, you have to be prepared to deal possibly with fragile banks. So I think what is needed really is a coordinated approach across these different policy areas and the different authorities. I mean, we've seen during the crisis, for example, that the border between fiscal and monetary policy has been kind of overstepped, and I think rightly so. And I think something similar has to be happening when we kind of exit from these different support measures. Of course, the important thing is to think about possible cliff effects and how to avoid them. But let me stop here and go maybe to questions or the second round. Thanks.
Okay, thank you. So maybe let's just focus for a second in the presentation that we have heard before going to the second round. Let me go back maybe to Jakob. So first, in what you expressed to us, it was interesting to me when I first saw your presentation, because we have actually a paper that I have been writing with other four female colleagues of mine on coverage ratios. Not on NPLs directly, but on coverage ratio. And in that paper that is now published in the Economic Policy, we actually found that bank-specific variables were more important in explaining coverage ratio relative to macroeconomic factors. So the question I had for you was whether you feel that there may be a difference in your study if you had considered more specifically coverage ratio rather than non-performing loan gross, which I think you are focusing. And in general, why we're not looking so much at coverage ratios, but we tend to talk about gross NPLs, whereas the impact ultimately of NPLs on bank capital depends on the provision that the bank has set apart. not so much on the amount of gross NPL. And there is not always, what we found at least in our work, there is not always a one-to-one correspondence between the level of NPL and the coverage ratio that the bank have. So I just wanted to have your reaction on this. Jakob?
Thank you for this question. Yeah, I don't know. I was kind of surprised that we found that most of these bank-specific variables were not very important in explaining NPLs, because we had a huge data set, a lot of variability, and the basic question that we asked in our paper is, can we explain these different NPL performance based on bank-specific characteristics? And I had expected that indeed several of these bank-specific characteristics would matter. But as I said in my presentation, most of these variables that we considered turned out to be not significant or only marginally significant. So for me, that's a surprise. And your paper apparently suggests that when you look at coverage ratios, the story becomes different. I have to read that paper, very interesting. And I don't know yet why you find that these bank-specific factors are so important in explaining coverage ratios, while in our analysis focusing on NPLs, we do not find that effect. I agree that in the end, if you're interested in the effects of NPLs, it's good to also focus on coverage ratios, because obviously, it's not just the level of NPLs that matters, but in the end also how well are you able to deal with those NPLs in case they increase. Yeah, but as I said, the paper that we have written focuses on explaining NPLs as such and not the impact they have. I mean, that's not to say that this impact question is not relevant. Of course it is, but that's not what we did in our paper. I don't know why we came up with this result. We really tortured the data a lot, I can tell you. And I was stunned by the fact that most of these variables, bank-specific variables that we considered, hardly mattered. In fact, if you look at the R-squared of our models, it's extremely low. So even though we controlled for macro factors and tried a whole array of bank-specific factors, the explanatory power of the model was very poor.
No, this is something that we share, and this is why we then came up with saying that there are some unobservable characteristics that seem to explain a lot the coverage ratio, and something beyond what we can capture in our variables comes into play. That was the same in our case as well, that the R-squared were not very high. Anyway, going back to more general discussion, there is another question inside that we can handle here. Maybe I can start with you and then go to the other panelists, which is how to find the right balance between avoiding too many bankruptcies and NPLs and creating zombie firms. This was a little bit of discussion. And so all of you praised somehow very much the public measure, but then of course there is always the risk of zombie lending. So what's your view on this?
This morning, I just read a piece from former colleagues of mine at the Dutch Central Bank, and that's precisely on this topic. So they analyzed to what extent firms receive government support, which actually could have done without this government support. And it turned out that indeed quite a few firms got support. Well, they probably would have survived without it. And at the same time, they also showed that quite a few firms got support, while it's questionable whether these firms would survive in the end. Yeah, so that suggests that indeed quite a bit of the support ended up with firms that in the end turn out to be not viable, despite the support. So they temporarily are kept alive, but they will not survive in the end. And that is indeed one of the reasons why I think it may have been very helpful during the COVID pandemic. But I'm not so sure how long you can sustain this kind of support, precisely because in the end, you take away much of the dynamic that Thorsten was also referring to, a la Hayek and Schumpeter. And that's indeed one of my worries, and that's also why I favor to stop these support measures as quickly as we can. At the same time, I see also Thorsten's argument that, you know, if all these support measures at the same time are cut back, you know, that may create in itself, you know, an impact that we could perhaps avoid by better coordination. But for sure, for me, this is not a model that we should repeat every time when there's a crisis, and for sure not too long.
Okay, Maciej, what is your view on this? Because I understand on the moratoria that somehow, let's say, all firms could have asked for the moratoria. There were no specific requirement to start with. But for example, if we think of public guarantees, in principle, only performing firms could have asked for them. So performing firms at the beginning of the pandemic, and then as the time went by, firms that anyway could show that they were still performing in some form, whatever. Although, of course, the more we came into the pandemic, the more difficult probably was to really verify the real status of the companies. But in a way, at least on paper, the guarantees were designed in a way not to support zombie lending. In principle, I would say. I see Jakob knocking. But what Rainer, also Thorsten, what Rainer and Maciej think, and then we go to Thorsten on this precise topic.
I can maybe start, if you allow me.
Sure.
I think where I have a bit of an issue is this very binary distinction between a zombie firm and whatever is the opposite of a zombie firm, a living firm. I think we've done some work using a fuzzy definition of a zombie firm. And I think what that shows is that there are very many firms in the gray zone. There are far more firms where you can't really say with certainty that they are a zombie, but you could say, well, they look like 2/3 zombie, 70% zombie, 80% zombie. So I think that just shows how difficult it could be to build criteria. And don't forget, I mean, these schemes were all set up in a rush very quickly. So the room to think about very elaborate criteria was limited, and these might have been counterproductive. So my take is, there are inevitably some zombie firms, and I think we show that in that paper, that did benefit from guarantees, and you can't rule them out. But I think in the grand scheme of things, it was still the right thing to do, because there were far more, the share of firms that were actually alive firms with good prospects was much larger. The other point I wanted to raise is it's perhaps more important to have the right kind of framework to restructure these firms than to focus on, let's say, the past guarantees that might have been granted. And we know, I think there's still something to be done on efficiency of insolvency framework, on preventive insolvencies, on making sure that these companies that actually have some kind of viable business model underneath, but may have operational problems or may have excessive debt, that they would be dealt with without creating collateral damage to the economy. And I think that's perhaps a more important problem than focusing on trying to get fine-tuned zombie definitions and fine-tuned guarantee schemes at the moment. But happy to be challenged on that. I know I'm sure there are other views around this table.
It seems, I'm afraid. Rainer.
Yeah, thanks very much. No, I would very much agree with what Maciej said, and I think it's really a matter of many different variations of gray rather than black and white. So we had an event here recently which was quite interesting, and there was also some speakers from Asia who looked at the experience of Asian countries with zombie firms. And they had very long-lasting experiences with this, but usually only when there was I think what one of them called an unholy trilogy. So you needed to have the zombie firms, and then you needed to have zombie banks that keep them somehow alive, and you need to have the political will to keep these zombie banks alive for a long period of time by, perpetually injecting money into them or directly into the firm. Of course, that's another way. So as long as this is not given, I wouldn't be too concerned, even if we have created some zombies, that this becomes a very persistent phenomenon in Europe.
Thorsten, you were knocking before.
Yes, so I think actually, also first of all, I agree that there are 50 shades of grey when it comes to zombies, of course. I mean, so just coming back on what Jakob started saying, so I think I mean, the COVID shock was a unique shock in the sense that there wasn't a kind of a drop in either demand or supply. I mean, it was a government-imposed drop in demand and supply, right? And I think this kind of the uniqueness of the shock and the extreme degree of uncertainty. And I heard, of course, José Manuel saying earlier about these the increase in uncertainty, but I think this is still it was a different type of uncertainty. It was this kind of unknown, as Donald Rumsfeld would have said. And I think that's why all of this, I think it was justified to put in these all of these support measures and do it also very quickly. And I take Elena's point that it was supposedly only for performing firms, but yes, right. I mean, these things were just pushed out like crazy, right? I mean, and there has been enormous, not just maybe also to non-performing firms. I mean, at least I know for the UK, there's been lots of fraud as well. And I mean, some of this could have been avoided, of course, but probably not all of it. So that's just something that has to be written off. I mean, the question is really, and here I now also agree, I mean, I would have said it differently probably half a year ago, but now I would also say, I mean, the markets are working again, right? The markets, for example, I mean, again, know from my own possibility, I mean, I worked for half a year here in Florence, but not being in Florence, but in London, because I couldn't go back and forth because of the travel restrictions, right? And then these things have gone now. Pretty much, for the moment at least. I mean, lots of other restrictions have gone. I mean, so the markets are working again. The hysteresis problem hasn't been really turned out to be that big. I mean, there is not an increase in unemployment. So I would also say, yes, there's all signals on green to go back to the market process. So I would actually agree on that. And again, the issue is, I mean, coming back to the 50 shades of zombie gray. I mean, I think I mean, we can broadly distinguish between three groups, and again, there's of course an overlap again. The ones that are viable and come out of the crisis well, the ones that are viable but possibly over indebted, and then the ones that are over indebted and possibly not even viable anymore, right? Being able to distinguish them and address these different problems, I think that's going to be the issue. And it could also be, I mean, actually, and Elena pointed me to this at some point, I mean, there might be firms that look unviable with the current business model, but might be able to change their business model towards becoming viable, but might still be over indebted, right? And I think kind of the mix of how to deal with that, including maybe also giving certain tax incentives to deal with it, I think that's going to be important. And again, I think more reallocation will be needed. And again, coming back to your point, Elena, that only performing firms would have gotten loans. Well, some of these firms might not be performing anymore, might not be viable anymore now, right? Because there are certain sectors that have to shrink. And with the Ukraine invasion and the consequent energy transition that is needed, that's going to be accelerated, there might be more of these firms that might not either are not viable anymore, or at least are not viable in their current business model anymore, right? So there more kind of reallocation is being needed. And I think they are kind of fostering that and avoiding exactly that problem that Rainer thinks is not really at the horizon, and he might be right. I hope he's right. I think that's to address that is critical to avoid this kind of this unholy trinity, I guess, of zombie firms, zombie banks, and we don't call them zombie politicians, right? How do we call them? Zombie-loving politicians? I don't know. So, anyway, thanks.
Okay, so let's stop here for the first round. Let's say I think we have a general agreement that we have to be careful, at least, with the firms that should not be kept alive indefinitely, but we should rather try to deal with them. And also, I think we have a little bit of an agreement that the public measures that have been put in place were very effective in not seeing a huge surge in NPL so far, but that somehow we should think of, if we hadn't had this new shock that now we're going to talk about more in details, we should sort of thinking of winding them down, because anyway, markets should be restored. Let's look now if this new shock has brought some differences in our thinking. So if we see the need of bringing this policy back, maintaining them, or do something else, including maybe considering large shock, and as Ernst is putting his question differently in our stress test or in our banking analysis. But why don't we go back to Rainer and Maciej in particular, that have a little bit more presentation on the current situation, so then we can focus more precisely on this aspect. Maybe we start with the Rainer this time, and then Maciej, that has the scenario that ECB is now using for the Russian-Ukraine situation.
Okay, thank you very much. I hope it works better this time. Okay,
Yeah.
you see my screen? Yeah,
yes.
Okay. There's some learning curve here as well. Good. Okay, well, let me start by recalling then the challenges that we see on the NPL landscape going forward. And I don't think I need to go into great details here, because most of this has already been mentioned, or in the case of the war in Ukraine, I think Maciej will look into this in far more detail. Maybe two reminders. First of all, this is probably less of an issue, but some countries in the euro area still have a relatively high stock of legacy NPLs, so they are not starting exactly with a clean slate. And secondly, and this is at the bottom of this slide here, as a result of all these support measures, and I would also say as a result of many years of very accommodative monetary policy, of course, we are faced with rather, let's say, highly valued, if not overvalued, asset prices, in particular in real estate. And we also face an increased level of indebtedness, both by households, by companies, and of course also by the public sector. And when you look at determinants of NPL, these are probably not the most important ones. So variations in GDP are certainly more important than that, or also unemployment, but they do also play a role. So this is something that I would say are risks. And with this slide here, this is just to illustrate the rather strong increase in house prices that we've seen, and the increase in corporate and household indebtedness. And government indebtedness in the euro area, for example, between 2019 and 2021 has increased by 14 percentage points. So this is really quite a strong increase. And of course, that's something that has to be taken into account. Now, what does that mean? I think one of the key lessons of the last wave was that dealing with an increase in NPLs when the wave is sort of building up is that it's really of essence to have a speedy approach to this. And to do that, and in light of all these risks that I just mentioned, I think it's very important to close the remaining gaps in I would call here NPL infrastructure. And of course, as I said earlier, a lot has been done. We're in a much, much better position than we were, say, 10 years ago, or even 6, 7 years ago. But still, not everything has been completed. So just mentioning here a few important points. First of all, there is the review of loan enforcement regimes and insolvency frameworks. This was identified in the action plan as a very important part to improve NPL resolution framework. Some work went into this, but this is far from over. So because it's of course hard to make policy changes in this field. So here more should be done. Second, there are still remaining obstacles for the functioning of the secondary NPL markets. And NPL securitization schemes are actually a good case in point. So Maciej mentioned that they were very important in reducing the existing stock of non-performing loans, and that is great. And I think the Italian GACS scheme has been there very, very good. But still, it's to some extent held back by considerations to limit the risks that governments are taking and to avoid state aid. So more precisely, so the state guarantee is really restricted to the senior tranche of such schemes. There are good reasons for it, But if we have to face a new wave of NPL, then maybe this is not the ultimate approach that should be used. And something very similar applies to the regulatory framework, the state aid framework for asset management companies. So as I said, 3 of them were used rather successfully to deal with the previous wave. That was Ireland, Spain, Slovenia. But since then, none of them was used. And why is this? Well, simply the hurdles that are being built up here in terms of the state aid requirements and the requirements to bail in investors and to some extent also other stakeholders in when such a scheme is set up are very, very high. Again, good reasons for this. There is moral hazard issues that should be taken into account, definitely. But whether we have reached here the ultimate or the perfect long-term steady state, I'm not sure. There's been also, of course, discussions repeatedly on whether an AMC or AMC type or network of AMCs should be set up at the EU level or euro area level. Well, that is something that is, I think, something of last resort, I would say. But it's something that should still be at least made possible. So the groundwork for this should not be just dropped, but it should be continued in a way that if it's needed, something like this can happen. And this brings me to the last slide here. This is still elaborating a little bit on the AMC story. So they have actually a strong track record. They have a strong track record in Europe, but also in some Asian countries, if and only if, and that's a strong if they are properly designed and managed. But we know now how this thing can be done, right? So this is not something where we are still in the dark. So they have a couple of important advantages. They don't require large startup costs. They create, however, contingent public liabilities if they are publicly owned, and that's of course one of the reasons why there is some hesitation. But, and I will wrap up here, other countries like in Asia, for example, they often see AMCs as part of a crisis infrastructure. As a crisis infrastructure that is complementing other components that we see here, like ELA, lender of last resort function, like a deposit guarantee fund, and so on. And I think it's worth thinking about this also for Europe, given that now we have 15 years of crises and problems and risks, one after the other. Maybe it is a good idea to bolster the infrastructure and include this sort of NPL resolution approach in it. Not necessarily to use it already, but once a situation occurs, that then it's ready to be deployed in a reasonably short period of time. So thank you very much.
Thank you, Rainer. Thank you very much. This is actually an important point that you make. So maybe we are not now in the situation where MSC would be needed, at least if we think of the first round effect of the new situation. But they should be there as a part of the toolkit so that they can be activated if a shock realizes, and we could then respond much faster at that point to the shock. But let me go to Maciej, because in a way we are a little bit, I wouldn't say surprised, or I should say we're surprised of the optimism that we hear about the new situation and what scenario we may have in front of us, although we understood also from Pier Carlo and José Manuel before that, of course, there is such uncertainty right now that it's very difficult to see where we are actually standing in terms of scenarios. But let's see what are the current ECB scenarios on the new situation, please. Now we see the slides.
Thank you. Perfect. Yes. So I fully agree that this is a very early point in this crisis, and I think making any firm assessments comes with a big margin of error. So don't take it as written stone. We know that some transmission channels in the financial sector are clear and well documented. Some others may perhaps be more visible only over time. And I'd like to focus here on 3 facts. And the first I would like to point out is that we have now, fortunately, transparency about direct exposure to Russia, Ukraine, and any direct risks. And this is really a helpful lesson from many of the past crises, because unlike, for instance, in the global financial crisis, we don't have now analysts having to make sophisticated worst case scenario assumptions, because we know what that exposure is. And it is actually pretty limited. So this chart here comes from a speech that our chair of the supervisory board, Mr. Enria, gave last week. And I think it squares with bank disclosures very well. It basically shows that overall the exposure is in the region of, let's say, 6% of total capital. This is original exposure, so you probably would need to haircut this because a lot of this is committed credit lines, which isn't really money committed yet. It's not money lent out. It's an off-balance sheet position. And on top of that, significant chunk of this exposure is in local Russian subsidiaries, which is locally funded. So that's obviously a very different case to cross-border direct lending funded out of the head office. But overall, as I said, 6%, which looks like a pretty manageable exposure in proportion to capital. Now, the market reaction that you can see on the right-hand side chart here suggests that at least some of the analysts thought there is much more than this. The peak depletion in capitalization is nearly 25%. So this is about 4 times as much as that direct exposure. So essentially, if you take this at face value, it's full write-off and a lot of other damage from indirect second round effects. Now, this has retraced significantly. So analysts re-evaluate their view. Perhaps maybe the market has oversold. The second issue I would like to focus on is commodity markets. Here we've seen very large price movements in some commodities, in particular those where Ukraine or Russia are large suppliers. And there are certainly concerns about supply continuity and value chains. We've seen limited spillovers to other commodities. But I think what's important is that such large price moves may imply very persistent sectoral dispersion in terms of any impact on asset quality and also any impact on economy. But let's say to put some silver lining again around this, unlike in the COVID pandemic, where all the contact intensive sectors, such as leisure, travel, were very highly affected, this time that composition of sectoral impact may be different. So I think energy intensity could be a factor to watch. And sectors which need these energy resources as inputs, but may have difficulties in passing on the price to customers, could be among the more affected sectors and firms. And then the third issue is the broader macro spillover from all this, and especially from the energy disruptions. And here I'd like to, in a way, lean back on the work of ECB staff who prepare macroeconomic projections every quarter. This was released about 2 weeks ago, and they dealt with this question basically with scenario analysis. And they've constructed 2 scenarios, differing in terms of severity, but fairly similar in terms of narrative elements. They essentially all assume that there would be some further increase in energy prices, disruption in gas supplies through cuts of Russian deliveries to Europe. That would lead to higher energy costs, cuts in euro area production, but there would be some substitution effect happening over time as other energy sources would at least partly would fill the gap. And you can see that this is complemented with some further work on assumptions on geopolitical tension, on financial market confidence, and on trade shocks. And overall, it looks like these scenarios would lead to a slowdown in growth. So under the less severe of these 2 scenarios, which is depicted with the yellow bars, you could see that the GDP growth rate in the euro area may decline by just above a percentage point, but that still would put it at 2.5% this year, slightly over that next year, and converging towards just a tad above 2% in 2024. And the more severe scenario implies a slightly deeper and slightly more backloaded path of adjustment for GDP. So I think it's sufficient to say that these results are certainly, that this is certainly a material hit to growth. But if you compare that against the usual scenarios that we, together with the SRB, together with many other authorities, produce for the EBA stress test scenario exercises, for example, I think the severity here is certainly much much less pronounced than in the EBA scenarios. Like, just to recall, the last EBA scenario had a contraction in GDP of 3.6%, and that came on top of nearly 7% in the pandemic, because the scenario was still developed in late 2020, early 2021, when we were in the depth still of the recession. So as I said at the beginning, it's certainly way too early to call how this would play out for NPLs. Well, I think the suggestion, this all suggests here that at least, yes, unless you rule out significant escalation, the direction of travel would be towards weaker asset quality, but unlikely to match some of the severity of theoretical stress test exercises we have seen. And I think it's important also to bring back the point that José Manuel made it in his talk at the beginning, that banks have significant buffers, actually bigger buffers even than at the beginning of the pandemic, to deal with it. And I think I'll stop here and happy to take questions.
Thank you very much, Maciej. So let me well, first maybe to you, let me ask the question that Ernest has put in the chat. So COVID has taught us that we have to go much more granular in our scenario and stress testing analysis, given the very different impact across sectors. The Russian-Ukraine crisis, again, has highly diverse impact across sectors and also countries. Do banks and supervisors take account of these new strong asymmetries in the impact of large shocks, and how?
Yeah, so I think the short answer would be yes, we all, I mean, I'm not a supervisor. I need to perhaps explain myself. I'm on the macro prudential side of the bank.
But you will be involved in stress tests.
But nonetheless, I can say that yes, we do look at the sectoral effects, and I think that's one of the lessons from COVID, that maybe this traditional way of doing macro scenarios and macro stress tests is not always necessarily sufficiently granular to deal with very strong sectoral effects. So that's certainly something you need to pay attention to. Now, in practice, I think that also means that banks need to be able to adequately assess these risks, need to produce their own view on individual assets, prepare solutions for debtors, run their viability assessments, taking into account prospects of the firm, not just taking into account the macro trends, but also taking into account sectoral trends. Of course, many of them have been doing that, but if they haven't been doing that, then they definitely should try doing that. And I think what's important is to look at also trends in terms of ability to pay over the medium term and prospects for the sector. But I think that all falls under the same umbrella of doing sound, decent, proper credit analysis rather than focusing too much on individual sectors, which may also be a pitfall. So hope that handles the question.
Thank you. Let me go back to Jakob and Thorsten with, first of all, I mean, we all know that we are, as we have heard already several times today, we are in a situation of increased uncertainty or strong uncertainty. So it's very difficult to make predictions. But first, what's your reaction vis-a-vis the scenarios and the current thinking of the ECB on this Ukraine-Russia situation? So do you sort of share this, let me call it optimism, or not remark the pessimism at least on the situation? And the second, and this goes back to another question that Ernst had in the chat, assuming instead that we believe there is need of public intervention, or better, let me rephrase the question. Do you think there is need of public intervention? You said before, in particular, Jakob, that public measures should be limited. And absent the war, we should have gone out completely of the COVID measure, basically. That was your message. So do you think the new shock sort of calls back the need of some public measures, and eventually which ones, if we can learn something from the COVID situation? To Jakob and then to Thorsten.
Thank you. I'm rather pessimistic, to be honest. Not because I'm really that much afraid about bank exposures to Russia, but what really worries me most at the moment is the following. This morning, we got the latest information on consumer confidence in the Netherlands. and it turned out to be almost at an historical low. Only in 2013, consumer confidence was below current levels. And this has been caused by two factors. One is the inflation problem that we face, but on top came, of course, the shock of the war in Ukraine. And I'm really worried about the impact that this drop in consumer confidence may have, not only on consumer spending, broadly defined, but also in particular for my own country, the impact that it may have on the housing market. And the housing market in the Netherlands has been one of the drivers of the relatively good growth performance of the Netherlands during the last couple of years. That may also go in reverse. And then we get into a serious problem that also will affect in the end NPLs, because many households in the Netherlands are highly indebted. And until recently, a substantial part of households had negative equity. Thanks to the increase in housing prices, that changed very rapidly. But I think the reverse may also hold. If housing prices stop rising and in fact start dropping, again, quite a substantial part of Dutch households may have a situation of negative equity. And we all know that that implies that at some point, they will not be able to pay their mortgages anymore, especially if they get unemployed or if they get divorced or whatever. Yeah, so I can easily sketch a scenario which has a very negative impact in the end also on NPLs. So I'm not that optimistic, actually. Of course, we are all in great uncertainty, yeah, but I really am kind of worried about this potential development in my country. I don't know whether other countries are in a similar position, but this really worries me at the time, because if I'm right, then we not only get a situation of high unemployment, but also get into a situation of stagnant growth and increasing unemployment, with all the consequences that it may have for NPLs as well, especially for household loans.
Thorsten, let's see if we find some more optimism here somewhere.
I think I guess I'm in the middle. I'm not as pessimistic as Jakob. And actually, let me first come to Netherlands, because, I used to be a Dutch homeowner with negative equity. So I'm a bit surprised by your negativity, by your pessimism, Jakob, because we had this situation before. I mean, there were lots of people, including this one here, with negative equity in the early part of the last decade. And there was not, given again, there was no unemployment, of course. That was the one issue. And as you know, given that you have this great train system of yours over there, people just can commute across the country. So as I did. So I'm a bit surprised by your pessimism on that one, because that's again, we were in a situation before in the Netherlands. It didn't have this negative impact. So the country did grow. So I share with you a bit more the overall pessimism in terms of macroeconomic outlook. So I'm there for the euro area in general, or for Western Europe, given the military situation, given the threat that we're facing right now. But I'm probably more. I would probably then choose more wonder whether it's more the kind of, what is it called, the baseline or the severe scenario that ultimately we might be facing. So then again, there might be second round effects. On the inflation, I guess the main concern I would have, if there is if there were a rather quick tightening of monetary policy, what effect would that have on debt viability by some of the corporation in the euro area? And this would have some kind of unintended side effects, corporates and possibly also sovereigns. So that would be one of my kind of scare scenarios that I could kind of think of. Overall, I'm I guess somewhere in between, maybe not as optimistic as Maciej and his ECB colleague, but definitely not as pessimistic going forward. I see also lots of opportunities that can be used in terms of, again, accelerating the energy transition, for example.
Thank you, Thorsten. Rainer, what about you? But in particular, if I think of the latest slides that you show us, what about public responses? I mean, if we go with Maciej's scenario, maybe there is not much need of public responses because there is still not such something to worry about, and therefore maybe there is no need of public support. But if we go a little bit, as you were saying in your last remarks, we should be prepared more for the future in case something more, particularly in the second round, comes up. What would be your thinking? What is it that we could be doing? AMC, or do you think there could be something else? Because here it would be really be energy driven somehow, no? Apart from consumer confidence, maybe some more behavioral also reaction. Please.
No, that's right. So I would not be in favor of sort of proactively using more government money, for example. This is not what I would advocate, but really preparing the infrastructure. And what I'm a bit worried about, to be honest, is that I think some years ago already, 2-3 years ago, we declared victory on NPL. It's not a problem any longer. And during COVID, it didn't rise, so victory again. And I think there's a bit of a risk that the risks that we actually have for a new wave in asset quality deterioration is a bit underestimated. And all the improvements that we've made are very, very good, but we are not fully there. As I said, there are still issues that hold back the secondary market. It could still be better. And what is, I think, very important is to look again at the regulatory principles that we have regarding securitization and AMCs. And this has been something that pre-COVID was de facto impossible. Countries would not do this any longer because simply there was so many straitjackets that were coming surrounding such measures that they were becoming completely implausible. Now, at the beginning of COVID, I think the European Commission has, of course, put all of these things on hold for a period of time. I'm not advocating to put them permanently on hold, but what I would strongly advocate is to see whether we need a different medium-term balance with these rules, with state aid requirements, with competition rules also, and see whether we can calibrate something that is a little bit better adjusted to a quick reaction should such risks materialize. So that's what I would plead at. Not really, throwing more money now at things, definitely not. We don't know what is happening, but being prepared on a regulatory front and having the infrastructure in place that we can then react quickly should we need to.
Can I just very briefly second this? I mean, I would completely agree with that. I mean, there were also, again, as you know, maybe the discussions going on during the COVID crisis about what to do with a potential wave of NPLs. But so I think, as Rainer said, I think the regulatory framework is not in place right now. The legal framework is not in place, but I think it's also the politics, unfortunately. So there's also still lots of political resistance to kind of put into place on a euro area or EU level such an AMC, or at least linking national AMCs, for example. So I think that on both sides has to be worked on. And of course, we know that the EU moves forward in crisis situations. So maybe now is a good point not to throw money at it, absolutely not, but to at least put the conditions into place that if such a situation arises, to be ready for it.
Jakob, before I go back to Maciej, I see you agreeing to what has been just said.
Yeah, I totally agree. I think now is the time to prepare for a potentially very worse situation. Okay, my worst case scenario is not a prediction. Okay, I'm not that pessimistic that I know for sure that this is going to happen. But in my mind, this is definitely a possibility, and there are other transmission mechanisms that may lead to a similar outcome. Yeah, so the best way to prepare right now that we don't have, a huge NPL problem yet, is to prepare for that situation that we have it. Yeah, so that if it occurs, and I hope I'm wrong, but if it occurs, that we are all properly prepared. Yeah, so all the things that we can learn from past experiences in Europe, in Asia, wherever, we should use those insights and prepare so that when it happens, we can deal with it, and that we're not taken by surprise as in the past when it happened as well. So I think that even if you're an optimist, better prepare for the worst.
No, I would second what you just have said. What I was a bit surprised so far, at least in the reactions, in the policy reactions that we see, is that there hasn't been a big sign of further EU initiative. I think so. I was expecting, for example, like with the vaccine, that we would see for energy substitution, that we would see some more coordination at the European level, whereas it seems that the countries are moving a little bit one independent of the other. The same with, I don't know, I don't want to say the second next generation EU or whatever, but I was expecting a little bit more the recognition once again that this is an exogenous shock, if we can call it this way. And although it is asymmetric in the effect it may have, is anyway something that should bring countries together. But anyway, let me go back to Maciej and say whether the ECB is preparing somehow for an extreme scenario, or if there are more extreme scenarios that are run, or the idea of being prepared for whatever may happen.
I can't simply agree more that preparedness is important. So when I could have made it actually sound louder at the beginning that there is so much uncertainty about the outcome of this situation that, of course, whatever scenarios we build now, they can not stand the test of time very well. So I think preparing for a whole host of scenarios is in such circumstances absolutely an excellent idea. What I perhaps wanted also to say is that this, I think you see preparations in the banking sector being announced and discussed quite openly. So that is no secret that many banks come to the market and essentially explain not only their position, but also their potential thinking and scenarios for the exposures that they know about. So I think that is going on, and certainly there's a lot of planning that is being done for scenarios that are not, say, I wouldn't maybe call what I presented optimistic. I think it's a sound, fair assessment by economists at the bank and some sound market data. But I think obviously the markets are also thinking about scenarios that are not as benign as a 10% drop in bank share prices, but something bigger than that. So I'm sure there's a lot going on in that direction.
I hope that I think we will have to see the next months to see what happens, no? And in particular, something that maybe we haven't touched upon so much so far is the effect of sanctions, because that, of course, has an important repercussion on the real economy, not just for banks. So that is really something that maybe may have an effect on European economy to an extent which we don't yet understand, and may create a series of default also, no, in that we may not have a clear views at this stage. Okay, then let's stop here. Let's hope that the optimism of the scenario that Maciej has presented will materialize, and we will not be confronted with a huge increase in NPL. But let's first of all hope that the war is going to end soon. I think this is the first condition that we should all aim for. And let me then thank all the speakers for having been with us, for the presentation, for the insights. I have greatly enjoyed the discussion. And let me give the floor back to Ernst and the UniCredit Foundation, possibly for the final remarks before the time ends. Thank you.
Thank you very much, Elena. This concludes today's SUERF UniCredit workshop on post-COVID non-performing loans, effectiveness and efficiency of government interventions, implications for banks. I very much appreciate that the panel also went fairly deeply into the current challenges due to the changed circumstances as a result of the Russia-Ukrainian conflict and the sanctions, which might also in the end have strong repercussions on enterprises and on bank loans. Thank you to all speakers and moderators. Thank you to the nice cooperation with UniCredit and UniCredit Foundation. Thanks to all of you for your participation and interest. I hope to see you soon again at future SUERF events. Maybe Giannantonio, Analisa, do you want to say a few words of farewell?
Just to say hello to everybody and hoping to see you again next year, but in Milan at UniCredit.
I think this is an invitation that all of us cannot resist, and we hope that it will be a reality and it will be possible. Okay. So thanks again to all of you. Thanks for the nice cooperation. Kind regards and take care.
Thank you. Ciao.
Bye, Ernest.
Ciao.
Thank
Bye,
you,
everybody.
Ernest. Ciao.
Ciao.
Bye-bye, everybody.
Thank you.
Ciao, ciao.